behalf of the Atlanta Fed Law Enforcement, I just wanted to share some emergency information in case of an emergency. The exits are in the hallway behind me. Law enforcement will direct us out, and if they are also trained first responders in case there's a medical emergency. Please no photography when you're in the reception area this evening, but photographs are allowed in the conference center only. If you decide to leave the conference center, please see the receptionist desk for an escort. And we'll be starting in just a moment, actually. We'll be turning on our virtual, and we'll be live here in just a moment. Thank you.
Yeah, you should. Yeah. We're gonna kick us off. I always like
Welcome to the second annual Payments Inclusion Forum. My name is Jessica Washington. I lead the Payments and Research and Outreach Group here at the Atlanta Fed. I will be your MC for the afternoon. Thank you for joining us today. We are here at the Atlanta Fed, but this is a collaboration of dedicated staff from across the Federal Reserve System, and more importantly, with our critical partners, our stakeholders that are also joining us here in the room and many virtual attendees online. The virtual attendees will also get to engage in the discussion by use of our Q&A Slido platform, which I will share when the time comes. A decade ago, I didn't know what payments inclusion was or if it was a thing. Back then, all the hype was about disruption, innovation, and Fintech. The world was increasingly digitizing. The fruits of Check 21 were being realized. Same-day ACH was introduced, and volume has already grown quite significantly. And then a task force came together and decided we could make payments faster, and we did. The RTP rolled out, the clearinghouse rolled out RTP, and the Fed made FedNow available. But these innovations have shifted and improved the payments ecosystem. But however, not everyone can participate in the digital payments economy. For instance, cash-reliant, vulnerable, or marginalized populations can be further marginalized when they are without access to the economy. And that shifts our thinking, and that's why this forum is going on today. That's why we're here for discussion. This is the continuation of research efforts that we've been engaged with over the past about 5 years, really. I've worked with many of you throughout those efforts. And a lot of these, the agenda we have today is the result of a special committee on payments inclusion that was a public and private partnership that really brought together key stakeholders into identifying what the barriers to digital payment adoption might be and what possible considerations for the future should be. We have an incredible agenda today. I'm really excited for it. We are going to hear about emerging, the most new emerging payments and how inclusive principles are being baked into the design. We are going to hear about the forthcoming national strategy for financial inclusion and how we can all work together in making that happen. We are also going to talk about going the last mile for financial inclusion, which will be a panel on cash in and cash out networks. But first, we have a fireside chat with two Fed leaders who have been champions for both inclusion and innovation. The president of the Atlanta Fed, Raphael Bostic, and Sunayna Tuteja, and the chief innovation officer for the Federal Reserve System. Thank you for your leadership in kicking off the discussion today. And we'll open for questions at the end.
Well, thank you, Jessica. And I should just say thank you for your leadership. It's been wonderful working with you over the past several years and all the team on the Special Committee for Payments Inclusion. It's been a true labor of love. And I think I would just say it exceeded my expectations about what we could accomplish, where we could go, and how we could create a conversation that would continue over a long period of time. Let me start by just welcoming you to Atlanta. It's good to have you here, Sunayna. And I want to welcome all of you to this conference. Those of you in the room, welcome to our building. And for those online, it's good to have you with us as well. It's really good to have the technology because it allows us to expand the conversation and make sure that more people are. Did my mic just go off? Okay. Some people will yell at me, they'll wave frantically. Technology usually doesn't work for me, so just expect it will come at some point. But it's really good to be able to expand the conversation beyond just the walls of this room. And so I'm really grateful that we have the technology. I want to thank our team for all the work they do to make everything that we do as accessible as possible. Let me start by just trying to create some context for you about how it is that Atlanta and our bank came to be engaged in the notion of payments inclusion. Now, we have a dual mandate. We're a central bank of the United States, so one mandate is stable prices. The other mandate is maximum employment. I like to say maximum sustainable employment. And when you think about that maximum employment context, it really is, in many regards, a commentary or assessment of how well the economy is working for people and how well are people able to participate in the economy and establish a level of economic mobility and resilience that allows them to do all the things that they want to do moving forward. Now, when you think about economic mobility and resilience, I think it starts with a job, right? So if you have a good job, you're going to have a good income that's going to allow you to do the things that you need to do. But a good job is not typically enough. And you need a financial system, you need a payment system, because I don't know about you, but when I bought my first house, I didn't have the several $100,000 in cash to be handing out. I needed a financial system to engage. And then we all live through transactions. So we need a payment system that also works for everyone. When I think about payments inclusion, I really think about it as having a payment system that is accessible to everyone, regardless of your geography or income or whatever, and regardless of how you want to pay or how you want to transact. So you're creating a variety of opportunities and pathways for people to engage in the payment system. And that really opens it up to the full range of possibilities in ways that is quite useful. And so our bank, we see increasing and improving economic mobility and resilience as one of our strategic priorities. If you look at a map of the United States, the Southeast does very poorly in pretty much every measure of economic mobility and economic resilience. And so we took it upon ourselves that if we want to have an economy that works for everyone, that issue has got to be tackled. And that got us to the broader issue, and then it ultimately got us to payments inclusion. So that's how we got here. I'm really excited that we are present in this conversation and helping to drive things. And that brings us to our fireside chat. Now, typically, when I have people from outside the building come into here, I ask them the questions, like you're on the hot seat, typically. But this time we're gonna flip it up a little bit. And I've agreed to put myself on the hot seat, which is always dangerous when you're with Sunayna. I'm just gonna say that right now. But you're gonna ask the questions. I will try to give some answers and we'll see how this goes. We're gonna try to leave about 10 minutes at the end for questions from you. But for now, looking forward to the conversation.
Excellent. Well, thank you. Thank you for that, President Bostic. And, thank you.
Okay. So no, you just call me Raphael.
Oh, okay.
Yeah,
all right.
This wasn't a technology.
Well, thank you, Raphael. It's always a delight to be at the fabulous ATL, Federal Reserve. You guys bring your A game, and I had to bring my A game, so I'm delighted to be here. And I think it's very apropos that you're in the hot seat because you, as you've said, have been standing tall on this topic, and the Atlanta Fed has been standing tall on this topic. So I think we'll double click on some of the themes that you've outlined, and I'm looking forward to the questions that we're going to get from our colleagues in the room, but also on the interwebs. So start thinking about your questions. So maybe double clicking on the theme, one of the things I heard you say is, we have to meet people where they are, right? So talk to us a little bit about, payments as a core function for the Federal Reserve and really that connective tissue to economic stability. But also, Jessica mentioned this in her opening comments as well, the increasing and accelerating role of technology in payments.
Yeah, so it's very interesting. There's some irony for me to be on stage talking about payments because when I agreed to do this job, I actually didn't know that much about payments. And Atlanta has been an important institution in the Federal Reserve System in delivering payment services. So I quickly had to come up to speed and really speak to these things. When I think about the Federal Reserve's role, I think about it in the context of safety and efficiency. All right, so we need to make sure that payments and they happen in a safe and sound way. And that is because our economy is really founded on the notion of confidence. And if people wonder or are afraid or are nervous about whether what they want to do is going to go through, that will break down people's willingness to invest and to purchase and to do all the things that are quite important. So we must make sure that the payment system operates in a safe and sound way. But in addition to that, if you can maximize the efficiency of the payment system, if you can reduce frictions so that payments operate with maximum efficiency, then you're actually spending the least amount of resources to get the most amount of output. And in economics, that's called surplus. And the more surplus you have, the more extra stuff you have to do the investments and to have your recreation and have a high quality of life. So we definitely have an incentive to be efficient as well as safe. And then the last one is timely, right? So you want, when you go to the store, you want to actually buy the thing. You don't want to wait 3 weeks and all that kind of stuff. So we do think about that. And Jessica talked about the faster payments aspect to this. It really is about trying to make this as timely as possible. Now, for me, you asked the question in the context of economic stability. I actually think about it much more in a personalized way. All right, so at the bank, what really very early on when I got here, people asked, do you have red lines? What are the things that really worry you, you don't want to do? And for me, one of them was, I never want to get called to testify, right? And so if the payment system stops functioning and you can't buy what you want at Target or Walmart or get your gas, I'm going to get called to testify, right? And so for me, that's stability. Like the stability sign is, if the payment system is creating that stability, then my life is a lot easier. I get to sleep easier. So it's really personal on that side. Now, in terms of technology, because that's the second part of your question, and one of the things that for me is really, it was eye-opening, is how much the Federal Reserve had been a driver of technological adoption and change in payments for many, many, many years. So for those of you who still engage with checks, you know, you can take a picture of the check now and that counts. Well, people in this building were key drivers of that innovation and helping to get that adopted throughout the US. That helped enhance efficiency considerably. The Federal Reserve had hundreds and hundreds of staff that were processing checks. And now checks are only processed in this country in one building, this one, and everywhere else has basically been shut down. So that's a huge amount of efficiency that's been added to the system, which is quite interesting. Now, when I think about it, technology, there are really two things. There's a question about what it enables, and there's a question about how it changes people's experiences. Now, on the enablement side, you know, I talked about the check pictures. We've actually introduced a technology very recently, about a year ago, called FedNow. FedNow is a real-time payment system. There's a sister system, the clearinghouse, called the real-time payments. And what that is trying to do is change fundamentally how clearing and settlement happens, such that it all happens basically instantaneously. So when you do the transaction, the clearing has happened and the settlement happens in real time. So that is actually a tremendous innovation, because that's not really how it works now. So if you deposit money in a bank, usually there's a 2 or 3 day hold before you can access those funds. That's because it takes time to do all the clearing and the settlement. If that can happen in real time, then there's no hold. And that offers tremendous benefits for consumers and for small businesses. For consumers, you get your money, right? And so and it's particularly important if you don't have a lot of wealth, if you don't have extra cash, getting that money in real time is going to help you buy the things you need, eat, get your clothing, go to work, and do those things without uncertainty or stress. There's another byproduct of this, which I think is also quite interesting, which is it should eliminate overdrafts, right? You should not be able to overdraft because that check is happening in real time. And if there's not enough money there, you're not going to buy it. you're not going to be able to buy it. And that should reduce and eliminate a ton of fees. And again, if you're income and wealth constrained, having some of your funds go to fees that are not productive or not beneficial, that's just a drag, that's a tax. And if we can eliminate that through a real-time payment system, that's very exciting. I also think about this in the small business side. So, when I talk to small businesses, one stress I hear from them all the time is cash flow. Right? They send an invoice, it takes a while, then the check comes, and it can be weeks before they get paid for their work. Real-time payments should really shorten that window as well. So small businesses should face fewer cash flow challenges, and that is actually a very positive thing. So that's the enablement side, and I think I'm looking forward to it. So our FedNow system has a bunch of banks have signed up for it. I'm really excited by how fast it's spreading, and I'm looking forward to it being present in as many banks as possible, and then being used so that we get those benefits. Now, on the experiential side, we do a survey, and I always mess up the surveys. I'm just gonna the names. I'm gonna look it up. It's called the Survey of Diary and Consumer Payment Choice. We run that. I think Jessica, your group does this one with our research team. We have a whole survey center here that does those things. Well, the most recent survey, we asked a question: how many have you used digital or mobile payments vehicle in the last 12 months? And the answer was 70% of all consumers had done that in the last 12 months. And that's a doubling of where we were 5 years ago, right? So how people are doing payments is changing quite dramatically. Then we asked the same question about with your phone, and it was actually a triple over that period of time. So we're starting to see technology really change how people experience the world. Now, this is a conversation we had a lot in our payments committee, special committee on payments inclusion, which is even with that, 90% of consumers still use cash for some things, right? So cash is not dead, right? And do you all have cash in your wallets? Oh, this is a good group. Like that's good. Yeah, so keep doing that. That's fine. Don't worry. You should still be okay. But I think it's a very interesting thing to think about how technology is deploying and how it's playing out.
I have cash in my wallet now. I didn't when I was in the private sector. So one of the desired outcome of working at the Fed is somehow now there's always cash in my wallet. So
victory.
Exactly.
Victory right there.
Thank you for that expansive response. And I really like how you injected examples and experiences because it punctuates the point that every payment has a story, right? There's somebody behind that transaction, that payment that's trying to achieve their own desired outcome. One of the things you also talked about is the need for the private and public sector to kind of work together to help solve these gnarly problems. And in Georgia, you're part of a group that is helping to advance this type of a partnership through a group called Partnership for Inclusive Innovation. I wonder if you can talk to us a little bit about the group and the role that you're playing as part of that.
Sure, I'm happy to do that. So I sit on the advisory board for the group. They call themselves PIN.
PIN.
Now I'm going to call it the partnership because I don't like acronyms, so I'm just gonna go that way. But like the partnership is really, it's something that a lieutenant governor of the state wanted to do, and he wanted Georgia to be seen as an innovation center for the eastern half of the United States. And for him, one of the things that was very important was that this shouldn't just be an Atlanta story, that this should be a story that really celebrates the full diversity of Georgia. And so we should be finding innovators and investing in innovation in all parts of the state, including many more rural areas. And like to me, this is a super interesting idea, and that's why I really was willing to participate in it. And in part, it was because I say all the time, I don't know where the next good idea is going to come from, right? And so we need to be probing all places, all communities, all slices of our society to be finding those ideas and to be seeing who might have that next great innovation, that next significant innovation, or that next great product that's going to add value. And what we've seen through PIN, through the partnership, is really a bearing out of that reality, right? So as we've encountered entrepreneurs across the state, they have come up with a lot of very interesting ideas. There's a group that is partnering, connecting urban communities that are food deserts with farmers in more rural parts of the state, so that if you have surplus vegetables and things, it doesn't just get thrown out, and now is being deployed in a very interesting way. They found investors, and it has now become an ongoing concern. That's a story that's replicated again and again. It really speaks to the idea that there are smart people, there are innovative people everywhere, and it's about networks and connectivity and information that can allow us to benefit by that. I would also say this is more than just the entrepreneurs. Right? This is also about cities, because sometimes cities will have ambitions about how they can deploy technology and innovation. So there's an international smart cities competition, and a couple of Georgia entrants won some awards in that. It was very, very exciting to see how ambition and innovation can really generate great things. It just really speaks to the importance of creating an ecosystem where good ideas can be invested in, they can rise up, they can add value. And that's another way that we can get the economy to work for everyone.
Yeah, I really like that heuristic. Granted, I may be talking my own book here around innovation, but I think that some of the case studies that I've read and that you've shared, they start with kind of a focus on problem statements, not so much chasing technology, but let's solve a real problem. And then kind of bringing together that diverse set of perspectives to kind of help solve it. And we always say kind of put your hands on keys and kind of learn by doing, because the perfect solution is not going to be designed on a document. So I think that heuristic is also helping with the pace of innovation.
Yeah, it's actually very interesting. All these innovations, I think about them as a journey, right? And I mean, we do this in our bank now. We talk about everything in terms of an experiment. Every new thing is we want to just take the first few steps, because we know there's a tension, we know there's a problem. We think we have a solution, but you're not really sure whether it's the full solution until you start going down that pathway and making discovery. And I feel like a lot of this is about the same kind of discovery that's really interesting.
Yeah, life in perpetual beta. So you talked about Atlanta Fed standing tall on the special committee on payments inclusion. I wonder if we could talk about some of the areas that you want to bring focus and attention to, with this captive audience here.
So I want to say a couple things on this. So first, the committee was great. And it was great to have a conversation that included experts from all over the place: private sector, public sector, operators, merchants, academics, advocates, governmental regulators, like the whole group was there. And what was interesting was, although they came from very different perspectives, they all kind of wanted the same thing. We want a payment system that really does work for everyone. And the challenge is, like, can we understand the barriers? And then can we coalesce around some solutions that can actually try to reduce them or even eliminate them? So, for one example of a barrier is merchant acceptance, right? So I tell a story about the first time I realized that cash wasn't going to get me what I wanted. And it was distressing. I was on a freeway and I was trying to get somewhere. I got to a toll booth and I was like, I don't know what I'm going to do now. I figured something out, and that'll be a story for a reception. But suffice it to say, it really did raise a question for me about if you are primarily a cash user, if you don't have a debit card or a credit card, like, how do you navigate an environment? And there are so many more venues today that are credit card only. Like, so many stadiums now, if you go to a show or anything like that, if you don't have a digital type of payment vehicle, you can't get in, right? And so thinking about those things and how you might supplement those technologies in ways that allow people want to use a variety of vehicles is an important thing. So that would just be one example. The committee put together a final report about a year and a half ago, I think it was, that laid out, I think, 7 different areas where we saw barriers that were worth trying to tackle, and had suggestions about areas that the government, the private sector, and nonprofits might actually think about exploring to see if there are solutions there. Another one would be just access to the hardware and the technology to leverage some of these digital payments. So if you go to many rural areas, access to broadband is not a given. And if you don't have broadband, you can't do a lot of the things that would be required. So that's another area where we would see some difficulty. The other thing I'm very excited about in this context is that our team is present in a lot of places. So we are engaged in a lot of working groups. So they're internal to the Fed, roundtables that are thinking about innovation, and there's one on payments. There's a digital idea network that we are also engaged with, and our team is writing a white paper with them to try to identify solutions. I think your team's involved with some of those things. We've stepped up a lot in terms of doing these sort of programs and having conferences to bring together folks from a wide range of places. And our team goes all over the place now, talking about this and the things that we're learning that are quite important. So it's been a great journey, and I'm so excited about the program today because it is allowing us to continue the conversation and bring all of you actually into the conversation, and hopefully by the end of today you'll be fired up to continue to work with us to try to make progress on these things.
Well, innovation is the ultimate team sport, and I'll definitely extend my thanks to Jessica, Lali, and team, because a lot of the work, as you said, that they're doing in Atlanta is extrapolated, and the beneficiary of the learnings are around the system. So we're very grateful for that. I'm gonna throw a couple more questions at Raphael, but get your questions ready because we're gonna come to the audience next. On that point, there's a lot of builders and developers here in the room, or investors and companies in the room, and also virtually. How should builders and developers of new products start to really think about and incorporate inclusion in the design and build process?
So that's an excellent question, and I'll just say they should think about inclusion at the very beginning. Like one thing so Atlanta has a ton of financial product innovators, Fintech Central, whatever you want to call it. And I talk to a lot of them, and many of them they approach it, Sunayna, as you said, they see a problem, they want to disrupt, they want to fix, but they're focused very narrowly on one maybe use case or one target population, and with little pokes and prods, you say, well, there are other people who might be wanting to engage in this. Have you thought about how they might think about it? And too often the answer, the response is they look at me kind of with this blank stare, like, what are you talking about? And so I really try to encourage folks, because in many instances, it's small tweaks that can lead to big changes in terms of accessibility. But once you're too far down the road, going back and doing the tweak then can seem like a mountain's worth of effort, right? So to the extent we can create a process or an expectation that one of the early questions you ask is, who else might use this beyond the group that I'm just thinking about? And then maybe trying to find those people, talk to them, understand what their challenges are, what their aspirations are. That process will broaden, I think, how you think about your innovation, and potentially lead to much more smooth and more broad adoption down the road, and more success in the product.
That's a pragmatic takeaway. Incorporate the voice of the customer, the voice of the user early and often in the process. I'm a I'm a pilot, so I think about that way. It's easy to make 1 to 2 degree course correction versus a 60-degree complete, change of course by talking to the users.
Yeah, I never want to be on a plane that's doing a 60-degree.
Want to go flying?
Okay, we'll explore that.
So I know there's never a productive meeting with Raphael until you walk out of there with some good call to action takeaways. I know, again, you have a captive audience. What are some action items that you would ask of this group?
All right, so they purposely did not put this in the program because many of you may not have come, but I like to give homework. Like, I don't like to have programs where people just walk away and they don't have to do anything. So my ask of you is to do things, to be engaged, to look at the challenges that are out there, try to understand where there are barriers and where you might actually think there are solutions, and then call somebody. And don't just sit on that knowledge, but rather have that turn into a dialogue. And the reality is, this is an all-hands situation. Right? If we're going to get to a payments system that is truly inclusive, it's going to require participation from everyone. Private sector, public sector, our whole group on our committee. That's our family, our universe. And I would invite you to be part of that discussion and conversation, because as with the small tweak can lead to broad adoption, like sometimes it's the small suggestion that can change a conversation's trajectory and lead to discovery that can be quite beneficial. So I want you to join us and be part of our group. That for those in the room, you're already here. I think we got you. We want to make sure that that the rest of the day moves in that direction. Those online, please do the same.
Questions from the audience. In the room, we have some mic runners, so please raise your hand if you have a question. And then if you would like to type your question into Slido, I can read the questions back to Raphael and Sunayna. And while the questions are coming in, I wanted to say, when you started at the bank, Raphael, you met with every employee, and I remember you sat with Dave Lott and I, and you said, just don't let me testify in Congress.
I really, that's a real story. That is real.
So we have a question here.
Hi, thank you. No, good. Okay. Thank you very much. Greg Johnson from New York University and Bretton Woods Committee. I'm just curious, are we in and out? So are we also taking into account to draw any inspiration on this topic from some of the other central bank work that's going on more broadly globally? In other words, so many of the things that are taking place at BIS and other locations, it's also trying to solve for the same solutions. I wonder if that factors into some of the things that either of the two of you are focusing on.
Yeah, so the question was, to what extent are we like trying to learn from things that are happening in other parts of the world? We are totally doing that. I don't really want to reinvent the wheel if someone else has already figured it out. We should just do that. Like I don't need the credit. I'll credit them. And in the report, it was actually quite interesting. We cite a number of international examples of innovations that are potentially interesting. And one of the things that I think is really, it caused me to really step back and reflect, is that the arc of technology adoption makes some technology leaps easier than others, right? And so you can see in Africa, for example, because they didn't have a large infrastructure investment in one area, they could just leapfrog to the current one, and in some regards they're more facile than we are, and our change will be harder. So we are definitely trying to learn those lessons.
Thank you for your question. We have another question from Slido. You've spoken previously about financial literacy and education. Can you tie back the importance of financial literacy with inclusion and innovation?
So yes, financial literacy is an important thing, right? If you don't know what you don't know, then you're going to stumble, and you're going to wind up in a bad way or a bad place. And I say it more that way than I need to know everything. Like I know I'm not going to know everything, but it's also knowing when you're starting to tread in areas where you could get in trouble. in the payments inclusion, I do think that part of the challenge that we have is that technology changes fast, and you don't always know all the utilities and the facilities that are there, but you also don't know all the risks. And one thing that we know, every new technology, it comes with great promise, but it also comes with new risks that you have to manage and navigate. And being able to have a conversation that is kind of transparent and honest on both of those dimensions, so that people can do the true benefit cost analysis. Like, we don't do that as much and as clearly as we might. Like, when I talk to innovators, they're always excited about the shiny thing. Look at this new thing, look at all these things we can do and all this sort of stuff. And I ask, so like, what do you think about sort of safety? And some of them haven't really thought about that. And so for me, I think part of this is creating a much more mature, holistic conversation in all of these spaces, so that everybody understands the full range of issues that need to be addressed if folks are really going to be comfortable to have that adoption.
Responsible innovation.
Exactly.
Okay. And we have a question in the room, Rodrigo.
Hello, good afternoon. My name is Rodrigo. I'm co-founder and CEO of Gabriel Money. And I have a comment and a question related to two comments that you just talked about. We are purposed to help young Latinos in the US close the wealth gap by accessing credit and non-predatory products. And we're early stage. We just found out that half of our customers are not Latinos. So to your previous point, some of the purpose and the new businesses that we're building can definitely have unthought broader audiences. But my question goes to your last comment related to innovation and the perception of risks related to it. I've been asking my sponsor bank, when are you going to have FedNow? And I want that for safety reasons, because the product that is my key product is a secure credit card, and I don't want to have ACH surfing going through it. Mm-hmm. And my sponsor bank answers me back, well, we have to understand because it might be too risky. So my question goes to how to address the perception of risk that comes with innovation that actually might not be true when people are just used to the old risks of the old technology, and to deal with that.
So that's an excellent question. I'd say two things. So first, let us know who that bank is. We definitely want to go talk with them and get them to adopt it, and we'll put them at ease. But I do think there is sort of a campaign element to this, to try to make sure that we're talking about these issues in regular language that regular people can understand, so that they don't feel like they're being sold something. Right. Ultimately, we need them to see this as a tool and something that they can leverage to their own benefit. And sometimes the hard sell just gets everyone on edge. And so it's really about, how do we talk about this? What materials are out there? What vehicles to communicate do we use? So I know the venues that I would look at where this might come across. That's different, perhaps, than the venues that you might use, Sunayna or Lolly or others in the room, depending on your background, depending on sort of the technology that existed when you grew up and all that kind of stuff. And so being creative about that and trying to be expansive I think is really the important element.
We have time for one more question, so I'm going to let you choose which one you want. Buffet.
Choice.
In your view, will impact of Dodd-Frank Section 1033 open banking, what will that have on financial inclusion in the future? Or please share your thoughts on non-bank participation in payments.
Well, I'm going to do the second one. Okay. But, that's pretty straightforward right there. So, look, there are a lot of non-banks in payments now. I mean, there's a lot of non-banks basically in banking. Right, we've seen a diversity of institutions find ways to participate, and to be honest, many of them have provided important value to consumers, because now consumers, all they want to do is the action. They don't want to be sensitive to if it's this type of institution, I got to do this, and if it's that kind of institution, I got to do that. So these overlays, these interfaces, they are all things that facilitate a better functioning payment system and financial system. And so we need them to be there. But the important thing is we need to have them in our conversations so they understand the risks that we're worrying about. They see sort of how they can interact, and they can better understand the challenges and the problems that maybe they've not seen before. So means we got to just make a few more phone calls in different sectors to be engaged. But it's a really exciting time. And I look forward to seeing where this will take us moving forward.
Well, thank you both for the encouragement and the insights and your leadership. And at this time, we're going to actually take a break for about 10 minutes, and we're going to come back with our emerging payments session. Thank you so much for your fireside chat. Take your seats, please. Okay, welcome back to the Payments Inclusion Forum. We will be kicking off our second session, which is Inclusion Principles in Emerging Products. Next to me, we have seated Brian Clark from the Boston Fed, a senior business strategy leader. Brian and I have been talking for many years, and we just met in person for the first time today, but we've been working together on inclusion efforts throughout the system, and Brian has been doing original research on these topics. And what's great is we have some practitioners in the room. Raphael and Sunayna were really telling us what can be done to enable responsible and equitable innovation in financial products, and we have some gentlemen that have been doing just that. We have Keith Vanderleest, head of payments at Cross River Bank. Welcome, Keith. And then next to him, we have Scott Estrada, the Director of Public Policy and Social Impact from Affirm. Thank you, gentlemen, for being here, and I'll hand the floor to Brian.
Great. Thanks, Jessica. And welcome to everyone. You all can probably tell who the Fed guy is because they have cooler footwear than I do. So I'm Brian Clark from the Boston Fed. So I'm going to take a few minutes here up front and just kind of frame why we're up here and kind of build off the last session. So the first thing I have to say, which is the least fun part of hosting a panel as a Fed employee, the views expressed here are my own and do not necessarily represent those of the Federal Reserve Bank of Boston or the Federal Reserve System. Okay, now that that's out of the way. As Jessica mentioned, spending some time doing some research on alternative financial services. And alternative financial services are the products you may associate most closely with are check cashing, money orders, non-bank bill pay, and payday loans. So when we announced we were building FedNow, since I work closely with low, moderate income populations in their intersection with the banking system, I began to do some research on alternative financial services because if you think about check cashing, money orders, non-bank bill pay, and payday loans, those four products are all around because of speed or settlement issues. So if you develop an instant payment network, you solve the speed and settlement issues. So I thought that an instant settlement network would have a big impact on low, moderate income populations. So we surveyed 300 users of alternative financial services, focusing most closely on earned wage access and non-bank bill pay. And we asked them, what do you like about the products you're using? Why are you paying so much money? Because those are very fee-heavy services. And they told us that it's speed, confirmation, and trust. So these are pretty basic principles that I think, building on the point that was made in the last session, that's what everyone wants from their banking products. And if you can solve a problem, if people are willing to pay a decent amount of money to solve those problems, then they'd probably be willing to try a different service that would offer those things for hopefully cheaper. So we're working with FedNow to understand where there's opportunities to engage with finance institutions on offering products that get at those issues. And we're developing data to help finance institutions make better decisions on their instant payments offerings. And hopefully in the next few weeks, I'll be releasing the results of the survey in a published paper. And one of the most surprising things for me, and the thing that got everyone's attention when I was talking about it originally, was that of our sample, 92% of the people had bank accounts already, and they weren't using them because they weren't getting what they needed from them. And then 90% of our sample said that they would prefer to use their bank account if it offered the same service. That is a population of people that are wanting their banking services to be designed for the needs that they have. And to me, that's just such a big opportunity. So in that spirit, we're coming together for this panel to talk about being responsive to what people need from their financial institutions, from their financial services providers. And both of you come from organizations that have a background in that excel in that area in different ways. So I wanted to start with Jessica introduced who you are by name, but if you could just talk for a few minutes about your organization and maybe a little bit about how your organization does respond to customers' needs and offer innovative products.
Yeah, sure. Thanks, Brian, and thanks, Jessica, for for having me. So my name is Keith Vanderleest. I lead the payments team at Crossover. Crossover is a bank. We've been around for 16 years. And we exclusively work with Fintech. So our customers are customers like Affirm, customers in the earned wage access space, all different types of Fintechs who are trying to bring financial services through technology to consumers and small businesses. From the start, we've always been very customer focused. Given our clients are Fintechs, they're always asking us to do the latest and greatest in whatever area of banking or payments. So within my area, most often it's focused on faster and faster forms of money movement. We built up competencies around ACH, then we did same-day ACH. We were one of the early sponsor banks for Visa Direct and MasterCard Send when our clients, some of them in the lending space and some other places, some of the verticals needed us to disperse funds on the weekends to your gig economy workers, your Uber drivers, your Lyft drivers who, you know, why do you have to wait until a Monday to get paid for your work that you completed on a Saturday or Sunday? And then we moved into faster payments on the bank rail. So we launched RTP back in 2020 and our high volume sender because we're on the send side, the merchant side. That's who our Fintechs are for RTP. And then we launched FedNow in September of last year. And we've seen adoption on both RTP and FedNow, and the way we've built RTP FedNow is kind of one interoperable rail. So we've always been focused on bringing financial services, and in my area specifically payments, to the masses. While we don't have a direct end user customer base, we access millions and millions of consumers and businesses through our Fintech clients, Fintech partners. So we're really excited about the innovation that is happening through Fintechs and financial services, and specifically in payments. And Affirm is a good partner of ours who's doing some of those things.
All right, it's a great segue. Thank you first to my fellow panelists and Jessica for putting this together. So my name is Scott Estrada. I'm a director of public policy at Affirm. So we like to frame ourselves as offering a transparent way for consumers to pay later for purchases they make presently. So we are a buy now, pay later firm. We've kind of been BNPL before BNPL was called as such. We've been doing this for about 10 years. And we've continually had to rethink and evolve of what it means to lend, to underwrite, for disclosures and credit since its founding. The very founding principle is that there is a better way to underwrite, to lend, and that's forced us to go through many iterations of the product and design, but our core mission of delivering honest financial products that improve lives and its radical simplicity actually requires a lot of attention through an evolving technology and regulatory landscape. So why I say this is that if a true commitment to that mission means a commitment to product design and certain policies. So it's going to sound a lot like I'm kind of just, extolling the virtues of Affirm, but when I say we charge no late fees ever since our history of the company, we provide disclosures well before the CFPB RFI that are TILA compliant, no gotcha fees. We've always classified our products as loans even before that was an issue. Those are all intentional, and those speak not only to the mission, but as we get further along in the discussion on financial inclusion, those are really at the core of how regulation can be responsive and pragmatic and ensure consumer protection and kind of separate, well, in fact, they can separate true innovation for financial inclusion from, I'm not naive enough to think there's not a lot of BS that kind of can flow along similar rails in both policy and marketing. So we stand behind the product, and I look forward to digging in a little bit in this discussion, especially as it relates to financial inclusion of what we're doing and what innovation really means.
Great. So as we were preparing for this a couple weeks ago, I said that I do like to add in what I'll call like a provocative or a controversial question. I don't think this is that controversial, and but I'll still maybe a little controversial sitting in here. So perhaps if, and this is a big if the consumer is getting the best product for themselves at the best cost, does it matter who they get it from? Does it matter who their service provider is when it comes to that?
So, I mean, I think the important thing to Raphael's comment about trust and security, banks are regulated, heavily regulated. And the reason for that is to protect consumers, protect end users. Now, when we onboard a partner, we expect them to have bank level compliance. While they are not regulated like we are, we expect them to uphold to the same standards that we have. So I think the short answer is, we've seen that banks and the financial system as it's designed does leave a lot of people out, hence the need for financial inclusion. And I think that is the role of fintechs to help bring more people into the financial system who historically have been excluded. So I think that the short answer is it doesn't need to come from a bank, as long as there is some way to ensure that the consumer, the small business is protected in the same way that they would get those services from a bank.
I think what I add, I definitely agree on the banking side for a firm. And again, this is going to sound very self-serving, but I trust there's enough skeptics in the room to keep me honest. In theory, in terms of the service, it shouldn't matter unless one of those products is doing something that the others can't. So I think it's more about a position in the marketplace in terms of what we're able to offer at scale, and in terms of a sustainability proposition, that it matters when it comes to product design or service design. So while if you can get the same service from multiple different providers, as in essence, you're getting to where you want to go. But a large part of our value proposition, and I promise we're going to get into it, is that we're doing something that nobody else can, both for finding profitability and lending to traditionally excluded communities, whether that's credit invisibles, LMI, or borrowers like myself, when I try to open up a telephone account while going to college, only to be found to be denied because it turns out I already had a telephone account and a light bill, even though I was 13. And it provoked some honest conversations with my mom. But the point of that is that traditional credit reporting and FICO scores egregiously misunderstand and misprice borrowers, especially on the cusp of near prime adjacent. And what we're able to do is bring those individuals into the fold and offer them products that would otherwise be barred to them when it comes to affordability and responsibility. And we work hand in hand with a lot of community advocacy groups on the state level, with Woodstock, that really informs in terms of what the real difference is between getting the same product from different providers.
Yeah, I think what Scott touched on is technology companies can innovate faster without sometimes the legacy of the traditional financial system, and there's less overhead, less tech debt, so they can quickly innovate and adapt to market trends and demographic changes that would help meet a changing population. The economy is changing, our population is changing, and that's where I think fintech companies like Affirm can really help lead the way in including those populations that have been excluded.
Yep. Switching gears a little bit, how are you tying innovation to consumer health so that the benefits span out across the marketplace? And in this space, why might quote unquote reasonable minds disagree on financial inclusion?
I can start off. I think the good example is, again, I talked about earlier, is like the litmus test between true innovation or kind of just digitized either high cost lending or traditional products. So for us, it's really in the underwriting. That's the ultimate value proposition of a firm and what the company is based on. Can we make loans, profit from them, and get paid back, and at its core? And when we talk about financial inclusion, this is really where cash flow underwriting comes into play. Our core customers, prime and near prime, it's kind of business as usual in terms of the underwriting outside of traditional options of credit products. But those borrowers that are on the cusp of near prime or subprime, those are the individuals that I said earlier. I think some research says somewhere between 11 and 30 million Americans are misunderstood or mispriced based on traditional credit reporting. FinReg Lab has a great report on cash flow underwriting. They said up to 20% of consumers are not getting the price that they should because of how credit is reported, and underwriting captures that. So what we do is for those borrowers that are on the cusp, we tie in bank data and say, okay, we need to connect to your bank, and through that cash flow underwriting, we're able to fold that into our model and offer these borrowers the same Affirm product, which means no late fees, TILA level disclosures, all the consumer protections that come with loans, no gotcha fees, the same experience that I said that when you get into a financial inclusion context, that they're not getting payday loans or pawn shop loans or high cost predatory loans. And that's where we break through from convenience and being better, faster than credit cards, which is a mission that we still are very invested in. And we start talking about financial inclusion, because these are the borrowers that don't have the same options from their Amex or their bank when it comes to liquidity management, and making it to the next pay cycle. So the innovation really is in the underwriting, and that's what I'll stand behind when it comes to a lot of the criticism, and some of it very reasonable skepticism. But they say something along the lines of BNPL is like kind of just layaway, but in the future. Well, that's not true, because layaway is not credit. There's no underwriting. Like, I still have a pair of Reebok pumps in Kmart in Connecticut that I gotta go pick up. Yeah. Or that it's installment lending, but just online. And that completely eschews the underwriting innovation. So when we, especially in today's regulatory landscape and all the action that's happening, putting an outsized influence on just a draconian skepticism of innovation broadly really mischaracterizes the problem. And that has disastrous effects from the communities that could really, really benefit from these products, like Affirm. So that I could go on, but I'll.
When prior to Crossover, I was at American Express, and we had an initiative for a while to go down the spectrum to the lower income spectrum, and one of our executives said, it's expensive to be poor, and that really stuck with me. And when I think about what we're doing for payments, we've been in a zero interest rate environment for a very long time, since the financial crisis. But now with rising interest rates, so many of our payment flows have been pieced together with a series of transactions, and each hop in that transaction has a pool of capital tied up. And the pool of capital is costing more and more with higher interest rates. Inevitably, that higher cost of that end-to-end payment with those pools of liquidity tied up will cause more expense for the end user. Again, whether that's a consumer or a business. So that's where I think, from a payments perspective, we're really excited about what FedNow and what RTP can do. Raphael talked about getting rid of the idea of clearing and settlement. You think about settlement, that just means there's a lag, there's a delay. It occurs in credit card, debit card payments. It occurs in ACH, but if we can get away from batch processes and settlement time, settlement windows, everything moves in real time. There are controls that need to be put in place to protect people. But if you can do that, that will keep the cost of the innovation that has happened in payments by, again, oftentimes it's a series of transactions. That's what I'm excited about from a payments perspective.
Yet, you said someone said it's expensive to be poor. And Raphael referenced that in his first session. He said, when he's talking about fees, he said that's a drag, that's a tax. And that's, some of the research I've been doing when I first started looking into products at alternative financial services users. Raphael gave homework. I can't give homework because I'm not the president of the Fed. But I would suggest that if you get a chance, go online to some of the companies that offer instant payments to pay things like bills. I'm not going to name any names. There's two big players in that space, and you can load in a payment and see how much they're going to charge you to send a payment that they very clearly market is going to get there pretty instantly. And, it can be frustrating for those of us that are working with Fed now, to the gentleman's point in the back, when we talk to banks about instant settlement, instant payment with this population, usually the first pushback we get is around fraud and how it's scary to do that, to allow your customers to send money instantly. And that can be very frustrating to have that be the piece that's going to hold back the innovation. So I'm excited about, what some of the more innovative companies will do when they have access to instant settlement in this particular space. So in the battle we called it the battle of the credit ecosystem, which is probably a little dramatic, but you've got competitors, laws, regulation, balancing innovation and risk. You mentioned payday lenders and pawn shops. Who are you up against? How do you balance promoting innovation to achieve digital financial inclusion with identifying, assessing, monitoring, and managing new risks?
I can kick it off. I spent a fair amount of time in advocacy in a national nonprofit, and both on the Senate side. I don't think it's very much of an overstatement to say it is a battle. Like the stakes are very high for the folks that are really sometimes actively in the crosshairs of some of the worst predatory lenders. So balancing the need to have protection and guardrails while recognizing that a lot of what we have now is not working for a lot of people, and innovation and evolution really is the way to solve old problems with new ways. It is a balance, and I think it requires good faith and rigorous participation from all stakeholders, advocates, regulators, the business community and industry, to have these guardrails and allow innovation to foster. So it's really hard for me, especially as days go on, to have productive conversations when folks say BNPL is unregulated. It really is not true in any sense of the term, both on a federal level with UDAP, and don't even get me started on the state level with money transmitting licenses, state licensed lenders, true lender. That's a whole other panel that'll take 47 years, and we'll get right where we started. When you talk about under-regulated or regulation or oversight with gaps, we're moving in the right direction, but that still evades a very fine line between what's outright evasion. And an example of that is a few years ago in California, companies that won't be named said, BNPL, we are not loans, we're retail credit. And the DFPI was like, turns out you are loans, and you've been making unlicensed loans for quite some time, and here's a consent order. This is to kind of bring it back, the founding of a firm, when we talk about aligning consumer financial health and consumer protection, since day one, we're like, we are loans, and we'll license and register as such. Contrast that idea with evolving. So like the current CFPB RFI on Reg Z's applicability to BNPL. We are delighted and appreciative of the director's decision to grant some reprieve for those companies seeking in good faith to comply with Reg Z. And our public letter will state that we are on board with the mission. We've been doing, a bit facetious, but I'm reading and I'm like, oh, if there's only a company that was not charging late fees, giving to the level disclosures, dispute resolution processes. But those are the guardrails we've been pushing for before this. And it's good for the industry, it's good for consumers. But that evolving need for regulation to fit over I'm sorry, the need for old regulation to fit over evolving products requires that collaboration. And we've seen the most success for consumers when we have that kind of good faith involvement from all stakeholders. Because, like I said, a more draconian approach against anti-innovation without really, and this is your earlier question about how reasonable minds can differ, defining innovation is the first part, and recognizing it as a solution, even if you're approaching it from a skeptical point of view, which is necessary, and that might be the consumer advocate in me speaking, but there are ways forward, and that's a large part is on correctly defining innovation and the problem it's trying to solve. Otherwise, you're going to have inaccurate policy problems and ineffective policy solutions.
I think sessions like this are really helpful. I spend a lot of my time educating our internal stakeholders around the innovation that our clients are trying to bring to market. They have, more traditional banking and payments backgrounds, and I need to kind of connect them with the innovation that our clients are doing, and we need to do that as an industry with our regulators. So bringing all the stakeholders together, bring the government, bring the private sector, have consumer representatives, I think is really important so that innovation can continue, yet there's still guidelines and framework and policy to guide that innovation, as opposed to what sometimes happens is it's very retroactive, and policy is slower to catch up with what is happening in the market.
And I went a little bit, I just want to take 2 more minutes because I just realized I didn't exactly answer your question. But the point I was trying to make was, especially when it comes to consumer protection and how do you balance that? I think the most recent example I gave of the CFPB is a good one, because it takes kind of in my opinion, the worst of credit cards, which is open-ended credit, revolving credit lines, no individual underwriting every time you swipe your card, whereas a firm, we do. But it keeps the consumer protections that are kind of essential to how, in essence, the credit card functions. So I think there are ways to have retain, in essence, or text the hard-won battles that consumer advocates and civil rights have made for economic equity, and transpose where we are heading in the future to make sure that they are not only effective, but forward-looking. So it's kind of looking at old things in a new way and finding out where the gaps are and having these collaborative conversations to find out, in the end, what's best for the consumer.
Great. So I want to talk a little bit about personal cash flow, not mine, but people who are your customers or your customers' customers. What's the promise of instant payments and managing cash flow, and or for Scott, what's the promise of being responsive to people's needs when they're managing their cash flow from your perspective?
I think financial literacy is very important, and many of our clients, a big part of their product is financial literacy, and then how can they help, whether it's credit builder products or earned wage access. If you just think about earned wage access, like it's kind of silly to think, why do you need to wait 2 weeks to get paid, right? So most of us, we're probably in a position that, we don't need to get paid daily, but we're in a very fortunate position. Many people don't have the cash to float money for days. They need to pay rent. They need to put food on the table. So why should they wait to get paid for 2 weeks, right? So I think that's just one area of innovation that we can help drive, and faster payments is a part of that. What we've seen specifically in earned wage access is a lot of people push to debit card, Visa Direct, MasterCard Send, and now with RTP and FedNow, you can get paid on the weekend. You get paid in the middle of the night. I mentioned the gig economy the rideshare driver, those types of people who need that extra income. They need it for a reason. They need it to put food on the table and to pay rent. So those are the things that I think there's a lot of promise. We still, so many of the unbanked and underbanked are recent immigrants to this country, and they have family back home, and they are trying to send money back home. That there's some tools out there to help, but I think, you know, to think about FedNow, RTP, and ACH, those are very domestic focused. We do need to figure out as an industry, what's the low cost way to get money to family and friends overseas who, you know, people are coming to this country, the American dream, right? A better life here, send money back home. But it's very expensive to send money back home. We're trying to work with some of our clients to make sure that that happens in a low cost way.
Yeah, I think I'll just add to that. You know, the cash flow management really, like I said, has high implications. And I'm just starting a little because you said that my parents are immigrants, and I'm the first generation to be born in this country. And you know, they were signing contracts for credit cards that they didn't even speak English, and went quickly into bankruptcy. And you know, before the Card Act, when I was in college, they're like, I signed up for 8 credit cards because I needed 8 ways to get a free sandwich, which was their incentive. And I'm like, Potbellies.
Oh, they have
sold.
t-shirts. They have
Yeah,
t-shirts.
I'm like,
I got a
sold.
cool t-shirt.
Yeah, I'm just like, and it was like, turns out that Potbelly sandwich cost me $87,000. But it really is of importance when we talk about cash flow management. And I think from a firm, in terms of meeting our customers where we are, and I know I probably have a minute left because it's right up there. We do have the Affirm card, which acts both as a debit card and a BNPL card. So you can go anywhere Visa is accepted. You swipe your card, and through the app, it'll ask, do you want to split this up into payments? And if you say no, it's a direct draw from your debit account. And if you say yes, then you get all the Affirm options that you're qualified for. And it's a $50 minimum. So, you know, there's probably not a need to split up a $9 Chipotle lunch. But this type of cash flow management has serious repercussions for individuals that or families that need it the most. And I think that's innovation. That's truly the definition of innovation, where consumers that need the most assistance in terms of, you know, I call liquidity management the most. And I just speak from personal experience, but also just from our own customers in terms of the success stories we've heard. So I had a better answer, but you kind of threw me off. And
sorry, I didn't mean to throw you off. But I know when you and I were talking before, we talked a little bit about how people can move their payment date around to match up with their income. Yeah. And, you know, that's it's something that's relatively simple. I'm not a developer, so I'm assuming it's relatively simple to do, but that people don't get paid on the 15th to 30th. Some people get paid Fridays. My wife gets paid every other Thursday. So just something like that, where you can make it match to when you know you have income coming in, it might seem like a small thing, but it can make a big difference when it comes to being inclusive of people that, you know, just get paid differently.
Yeah. And just 30 seconds, I promise. I was gonna say, just to that point, a lot of what we look at is like when you shift or displace the friction for application, and it's just as easy as hitting a button, there is a kind of a red flag there to make sure that people aren't getting overextended or stacking loans, especially when it comes to the credit reporting issue. So I'd be remiss to say, like, you know, at Affirm, that's where the cash flow underwriting comes into place. And that's why we're underwriting each individual transaction, from the $30 pair of jeans to the $500 couch. Every time you use the card, every time you apply for the loan, you're getting underwritten. And this is part of the balancing of frictionless consumer experience, but also ensuring our customers aren't getting overextended and they're taking out financing that they really can't afford. I promise that's
okay. Ready for audience questions? Yes. For everyone. So in the room, again, raise your hand, and we have some mics going around. And we'll start with.
I'm Princeton Williams. I work here at the Atlanta Fed in economic education. So one of the educational standards for seniors in their economics and personal finance course is to evaluate payment methods, right? So all the things, but what would be the top, you guys have talked a lot about guardrails and disclosures. So think about a 16-year-old, what would you tell them to look for in a payment method if they're trying to figure out which payment method to use? What would be the top 2 or 3 or 4 things to look for to really evaluate those methods of payment?
So I think it depends on what the payment is for. Obviously, I think of 16 teenagers, a lot of it's peer-to-peer payments. Make sure you know who you're paying. And there's a lot of peer-to-peer payment apps out there. And then there's a number of fintech programs out there. I'm not going to name names, but to the point of financial literacy for teenagers, trying to get them to not spend beyond their means, the importance of at an early age understanding credit, building that credit with guidance from an adult caretaker. I think that's the important thing. And again, there's a number of fintechs out there doing this.
Okay.
I mean, I can only speak to the credit product, but I think the top one would be like trust. Am I getting the true cost of what this is going to be? And do I trust if something goes wrong, I'm not going to be left out to dry? And now those are very colloquial ways of putting actual policy protections that exist. But I think those are the top 3, especially for borrowers that either don't have a not sophisticated yet understanding of credit, or those that still need to learn the nuances.
And I'll just jump in with a really quick anecdote. I had an intern, about 16 at the bank last year, and his method just fascinated me. He had the Cash App debit card. You can lock that, and he would literally unlock it when he was about to pay for lunch and then relock it when he was done. So I was like, I can't argue with your security methods there. That's a really innovative way to protect your information.
Question from the audience?
Hi, Carrie Sauer from SIA Partners. I have a question about how we can encourage upstream innovation. You think about the way that most people are paid these days. It started with the Industrial Revolution, right, on the 1st and the 15th, and most of the demand that you're seeing is because people can't make it from the 1st to the 15th or the 15th to the 1st. So there's a lot of pushing up from the bottom, right, from those customers, but how are we encouraging top-down innovation from the people who are making those payments, the employers, as well as the banks and the companies that are providing those payments?
So the programs that I'm aware of, they do go to the employers, and employers see the value add. Typically it's going to the HR and benefits teams, and they're using that offering as a benefit to their employees, to retain them, to empower financial mobility. So I think it is the right approach to go to the employers. I don't know if, hopefully the good employers will do that, whether there's something more broad that needs to be done to kind of push it. I'm always a fan of that, I think it's still a relatively free market, and that employees will be attracted to the employers who have the best offering.
And so where's the camera? So BNPL is not EWA. So we exist in different spaces, different worlds, but what Brian said, it really is about cash flow management. So through cash flow underwriting, we know you get paid X date, because we can see the deposit in your account. So the pay over 8 weeks, or our firm also offers pay over, our loan term goes all the way up to years. So you can pay monthly, because we know in aggregate over 4 months, you're able to afford this, even though you might not be able to afford it until next month or next week, but cumulatively you can. So that's really, it's the management of cash flow underwriting, the flexibility of the plans. And I guess this should have been an opening remark, but BNPL, as it's commonly understood for the CFPB report, is pay in full 0%. A firm offers bank partner loans that go up to 4 or 5 years, paying monthly, that are reported to the credit bureau. That also can be 0%, but are capped at its highest at 36% APR, with our average somewhere in the mid to high teens across our full portfolio. So just, and again, with BNPL and EWA, very different.
Another question from the audience.
Sure, thank you. So I had a question really sort of on the payment piece with the companies in general. I'm all for innovation, but one of the things that I think has become somewhat alarming, especially in sort of the recent case with the Synapse bankruptcy, is that a lot of customers don't really know what's under the hood of the companies that they're working with in payments. And so when something goes wrong, whether it's on the deposit side or sort of the pushing out payment side, they don't really have the support of regulators, or sometimes, like in the case of Synapse, they don't get to choose who their payment company is partnering with. And I'm wondering how you all are thinking about sort of if there are too many cooks in the kitchen behind the scenes versus sort of on the bank side, where there's a little bit more transparency and certainly more regulation around using a bank to, or credit union to make payments, and how you guys are thinking about that balance.
Yeah, so it's very interesting. So from a payments perspective, our major risk that we need to manage is BSA AML. There's other risks. You look at kind of what happened there. It was less about payments and more about deposits. Kind of regardless, our approach, whether it's for payments or deposits, is to be direct to the consumer with Fintech. No middleware provider. Like, our philosophy has always been, you know, from a payments perspective, again, BSA AML, we unnest anything that may look nested, right? So we are only one step removed from the end user, the end sender or recipient, so that we have visibility around both the sender and the recipient of that payment. No matter how many levels are between there, we have the data using technology. Same thing on the deposit side. We don't rely on a middleware. We are very much invested in technology. I know not every bank can invest in technology like we have done, but that's been our approach, so that there isn't layers of technology. You know, we have fintechs who want to get as close to the financial system, as close to a Fed master account as they can without being a bank. And so that's our approach. And then we ensure that they've got all the tools in place to manage the risk.
One more question from the audience, and then I have to do a couple of Slido questions.
Yes, thank you. Bob Skiba from Income Payments. A question for a retail buy now, pay later transaction. If the consumer that comes in and purchases the item fails to pay off the item, who's held culpable and responsible for that? Is it the retailer? Is it obviously it's the person that's signing up for the buy now, pay later, but who absorbs the loss then if they don't finish paying off the amount of the purchase?
So we do 100%, which is why the sustainability of the business requires us to get paid back. And I know that doesn't sound revolutionary, but when you look at some of the products that we're up against, especially the more predatory, the model isn't to get repaid back, it's to extract as many fees and as quickly and as fast as possible. So we do. The merchant gets paid, the consumer gets the item, the firm absorbs the loss. And this is where, especially on a 0%, $80, $100 loan, like, this is why our algorithm and our credit risk profiling has to work, or we don't exist. Because if enough people just walk away, then, you know, a firm will take all those losses. So that really is, in my opinion, the proof in the pudding is that our portfolio performance is the same or better than credit cards. And we're able to do it for smaller loans for subprime, near prime adjacent borrowers while taking that risk. And that risk is reflected in our ability to charge up to 36%, which we tie to the Military Lending Act, has the history and consumer protection of a good starting point of a line between affordable credit and higher cost credit. So longer answer than you probably wanted, but short answer is that we do affirm.
There's a question on Slido for Keith. Can you provide more detail into how Cross River fosters interoperability between FedNow and RTP?
Yeah, so when we when we built out, again, we were very much a technology first bank. We built a proprietary bank core that's all API first, which even for ACH, doing ACH via API versus a batch file is somewhat innovative. But obviously RTP we had built, and then when we looked at the differences in the spec and the differences in how the rails operated, we had a robust internal debate from the business side, product, treasury, risk, and we thought it was the best approach because we don't know how fast banks will adopt FedNow. We have some history with RTP adoption, but there's a long tail of banks that haven't adopted RTP. So we wanted to make one rail. Fintechs can select the rail, but then we've built some logic into the rail that looks at uptime. Is the routing number enabled for either network? Early on, we saw some lag time. There are downtimes with both networks, typically on the weekends when they're doing maintenance. So all of that goes into the logic to optimize. And again, the way the costs, there's some nuances, right? So FedNow is our master account versus the TCH account or ledger at the TCH account. But generally, its cost is indifferent. And then, there is a transaction size difference right now. Hopefully at some point there will be parity in the transaction size, but that would be another logic piece, 500,000 versus 1 million. Most often that dollar size doesn't come into play.
Thank you. We do have more questions online. We probably could go on a lot longer, but we're going to keep the program moving. This is a very exciting topic. Brian has a paper coming out about alternative, or some research coming out about alternative payments and emerging products. Gentlemen, thank you so much. This was incredible. There's a 10-minute break right now, so maybe some folks can catch their questions in the hallway, and we'll reconvene at 3:15 with working together for a national financial inclusion strategy. Welcome back to the Payments Inclusion Forum. We are up with session number 3, and we have working together on a national financial inclusion strategy. Further down, we have David Rothstein, Senior Principal at Bank On, Cities for Financial Empowerment Fund, Aaron Borge, Initiative Lead for Inclusive Financial Systems, Aspen Institute Financial Security Program, Lally Schaefer, from the Payments Forum at the Atlanta Fed here, and Natalia Lee, the Director in the Office of Consumer Policy for the United States Department of Treasury. I'm excited for this panel, and I'll let Lolly go ahead and take the lead. Thank you.
Thank you so much, Jessica. Is the sound okay? Can't really hear myself. Is it not on? Okay, we need to turn it up, please. Or is that me just needing to project my voice? Okay. Thank you, everybody, for joining us today. Lolly Schaefer. I'm going to be your moderator for this panel. And instead of sharing my background, I'm actually going to share a bit of payments trivia with you in the form of an anecdote. So this past summer, I thought I had the bright idea of taking my 13-year-old son all the way across the world to Japan. The kicker is that we traveled with 30 of his classmates. Now, I'll let you pause to shake your head at me because I know no one in their sane mind would say yes to that. But we embarked on that journey. We went all the way to Japan. It was a beautiful country, beautiful people, beautiful currency. Japan is the land of the rising sun. It is also the land of vending machines. If you've ever been there, they're on every corner. You can get everything from ice cream to beer. And if you're traveling with minors, that could be a little bit of a worry. But if you're the adult traveling with minors, it could be very welcome. So the vending machines became a necessity for us as tourists, but we had to carry around a lot of cash and coin. And if you didn't know, there are actually 3 different kinds of the 500 yen coin in circulation. The first 2 were retired due to fraud concerns because they were easy for counterfeiters to use. And so the third one, it's more complex. It has 2 different types of metals, and it has 3 different components. So in their efforts to shut out the fraudsters from their, from the coins, they actually also shut out consumers in that process. Why? Because some of the machines now for those vending machines don't take the new coins. Some of the parking meters don't take the coins, or even the city bus. So you're running late for work, trying to get on the bus, and their machine may not take your new coin. So we're here together today to talk about why it's important to work together on a national strategy so that nobody is shut out of that system. And what I want to do is start off with my panel, have them introduce themselves, and share a little bit of trivia and also their role within their organization. So we're going to start off first with Natalia. Describe your role and your team's focus at the Treasury, along with your bit of trivia.
Thanks, Lolly, and thanks for hosting me today. My name is Natalia Lee. I serve as the Director in the Office of Consumer Policy at the Treasury Department. My office formulates Treasury positions on a broad variety of economic, legislative, regulatory, market development policies that affect consumers. My office also manages and coordinates the activities of the Financial Literacy and Education Commission, which is 24-agency interagency body, chaired by the Treasury Secretary, that is dedicated to sort of advancing the well-being of consumers through financial education and literacy. I would say, because of our team's broad focus on consumer finance issues, we've been asked to lead on the National Financial Inclusion Strategy, which would be the first inclusion strategy for the United States. And we view this work as very, very complementary to Treasury's mission. So we administer a variety of capital access programs. We're also, you probably heard the Treasury Secretary speak about modern supply-side economics. And so what that really means is at Treasury, we really believe in investing in people, places, and infrastructure to broaden the economic opportunity across the nation. So we view this inclusion strategy as, again, strategic to advance financial inclusion in the United States, but also, provide a roadmap for stakeholders for implementation. So again, excited to be here. My piece of trivia is I'm a proud mother of 2 poodles. So for those of you who know, there's a royal poodle, which is a larger than the standard, and a miniature. So that's it.
Nice. Thank you so much. So let's go to David. Can you share your role in the what the Cities for Financial Empowerment Fund does, and also your bit of trivia as well?
Great, sure. So thank you again for having me and for hosting. I'm a senior principal for the Bank On program at the Cities for Financial Empowerment Fund, and our role is to work with municipal leaders and other partners across the country to help develop, foster, and run programs that create financial stability. And so those include the Bank On program, which is again focused on creating safe, affordable, and fully transactional checking accounts. And then also some programs that include financial counseling done at the municipal level as a free public service. And then some other programs that we run, including consumer protection and emergency financial counseling as well. So there's a host of programs. The connecting piece is always that we're, a national nonprofit that's looking to partner at the state and the local level. My piece of trivia is that I'm one of 6 kids. So there's, and we're all pretty much based in Ohio at this point. So I'm from Cleveland.
Excellent. Thank you so much, David. Erin, can you tell us a little bit about yourself and also what the Aspen Institute does?
Yeah. Hi, everyone. My name is Erin Borge. I lead our inclusive financial system portfolio at the Aspen Institute Financial Security Program. And if you're unfamiliar with the Aspen Institute or the Financial Security Program, the Aspen Institute was founded after World War II to bring together leaders across industry, public sector, and social sector to solve challenging and complex problems in civil society. And the Financial Security Program is one of 20 or more, the list is always growing, of public policy programs at the Aspen Institute. And at the Financial Security Program, our mission is to illuminate and solve some of the most complex and pressing financial challenges for American households, and also to elevate financial security as a national priority. So we're so excited that Treasury has done this work, and that's really in line with the work we're trying to do at the Financial Security Program. And my piece of trivia, I have a twin sister who also works in finance on the other side of the house in retirement world. So if you need advice on how to structure a 401k, that's the other sister.
Nice.
Lolly, what's your trivia?
Oh, so my bit of trivia, I'll say I have jumped out of a plane before, and that was through my own optionality. So I can tell you a little bit about that later. And I never even told my parents until I made it back to the ground because I did not want to worry them. That's how, crazy college kids go. All right, so let's move on here. I'm going to go to the second question. Basically, we're here today because Congress has directed the U.S. Department of Treasury to develop a strategy to improve the financial inclusion related to the Appropriations Act of 2023. The Treasury received input from a wide variety of stakeholders to identify clear and actionable opportunities for the public, private, and nonprofit sectors. So Natalia, I imagine this was a huge undertaking and still is. Can you tell us some of the behind the scenes or any interesting stories about that process?
Yeah, sure, happy to. First, I would say I'm also not the president of Atlanta Fed, but I do have a suggestion maybe for homework. The strategy is not out yet. It will be out later this year. So I do encourage everyone to take a look at the document, engage with it, and reach out to continue a conversation with us. But I would say, just to give you behind the scenes sort of in terms of process that went into the creating of the strategies, really one kind of phrase comes to mind, and it is, it takes a village. And so really in the United States context, financial inclusion does really take a village here. What I mean by that is we are blessed with a robust financial services ecosystem with a number of bank and non-bank firms that are participating in it. There are financial institutions that are for-profit, non-profit, et cetera, mission-driven. So, the depository sector alone boasts thousands of depositories out there between banks or credit unions. And of course, there are also mission-driven institutions like community development financial institutions, minority depository institutions, et cetera. So on top of that, overlaying it is really a complex and unique regulatory structure with both federal stakeholders, state stakeholders involved in it, as well as a robust nonprofit financial coaching, financial education industries operating within this financial ecosystem. So our job really was, and our intent was to make sure that the strategy is as representative of this diverse financial ecosystem that we have as possible. So we took it to heart, and we have organized a series of festivals, as I call them. Really, it's roundtables. I think to date, we've met with over 175 individual stakeholders. We have put out requests for information that closed earlier this year. I think we've gotten thousands and thousands of pages of sort of written feedback and input into our strategy. And, we've, I think in total got over 100 comment letters. So a really robust outreach process. Again, to ensure that the strategy is as representative as, we would like it to be. One interesting theme that kind of was recurring throughout these roundtables is something that we didn't necessarily expect at this stage, is really the persistent challenges the consumers face when trying to access very basic financial products. So I'm talking about transaction accounts. I'm not talking about, lines of credit, revolvers, like we're talking about like transaction accounts. And so, this was brought to us by a number of groups, including Muslim Americans, Arab Americans, new immigrants, refugees, etc. This became particularly interesting to me when, during this series of roundtables, outreach sort of conversations with stakeholders, I myself abruptly experienced the closure of my bank account at a major depository institution. And so, for reasons that they didn't really communicate. So it was most probably suspected fraud. But what that experience underscored to me is, one, how swiftly and quickly that happens and how vital these services really are, right? So for me, I fortunately did not experience sort of, negative consequences out of it, since I had other accounts at other institutions. But, a host of negative consequences for folks who don't have much slack in their finances, anything from declined transaction fees to bounce checks to just inability to access your funds. So that was, I think, something that, came through very personally to me, and sort of again, result fortunately for me, but underscored the importance of these vital relationships.
Excellent, thank you. And I'm sorry that you had to go through that account closure. Scary situation, I'm sure. Aaron, so I know you've done a lot of work on this topic as well, and I imagine you were as excited as we were when you found out about this national strategy. So how did the Aspen Institute collaborate with the Treasury?
Yeah, thanks, Ollie. We couldn't be more excited, and we are eagerly awaiting the release, as I'm sure many of you in this room are. So I'll take us back in time before the Treasury began writing the strategy. So back in 2021, my colleagues at the Financial Security Program worked with Senators Hickenlooper, Senator Coons, and Senator Warnock to call on the administration to develop a commission on financial inclusion. And the administration said, okay, cool. We've got a lot of priorities. Who's really asking for this? Is there an appetite for something this big and this weighty? And so we worked with a cross-sector group of what ended up being 110 signatories across major depository institutions, MDIs, CDFIs, fintechs, techs, but also civil rights organizations, consumer groups, and lots of our partners who have been in the financial inclusion space for a really long time. We brought that signatory letter back to the administration and said, here's everyone who is saying, yes, we need a national financial inclusion strategy. The US leads a lot in the global financial marketplace, but we were quite behind on developing a national financial inclusion strategy. There are about 60 countries that have developed an explicit financial inclusion strategy. So part of it was inspiring leaders and decision makers to take up that call to action. So once there was some movement in the call for a national financial inclusion strategy and appropriations, and Treasury took on the lead of writing that strategy, we then worked with a smaller subset of that signatory list and convened what we called a working group on inclusive finance of about 40 members, again, representing cross-sector, to help us really inform our own thinking about what priorities should be to be included in a national financial inclusion strategy. Just heard Natalia talk about the different facets of our financial system. And so this working group on inclusive finance really helped us sharpen our thinking on what are the 5 most important things that really need to be included in this strategy in order to actually move the needle on inclusion for households. And so we eagerly responded to Treasury's RFI and encouraged lots of our partners to submit responses to that RFI. So apologies, Natalia, for all the reading that your team had to do in combing through all of those responses.
Thank you so much, Erin. So clearly you did a lot of good collaborating with the Treasury. You were already thinking about this way ahead of time as well. So same question for you, David. How did the CFE Fund express their thoughts and share information in the process?
Sure. So we similarly we're very excited and anxious to submit comments. What we did is we went to the field. So again, we work with a lot of different partners from the Bank On program in particular. We have more than 100 local or state coalitions that include financial institutions, nonprofit organizations, municipal government and their agencies, like Jobs and Family Service departments or even city treasurer offices, as well as even some regional associations, trade associations, like bank and credit union associations. So we reached out to those coalitions, and we also have a lot of knowledge based on our interactions with the more than 460 financial institutions who have Bank On certified accounts, which means they've created a checking account that hits about 15 core strategy pieces that include being a safe account, an affordable account, and being fully transactional for customers. So we looked to the field, we looked to the programs to see where they've had success, and where they also saw opportunities. And what we really tried to focus on in our comments to keep the letter from being like 50 pages was around what we felt were clear and clear actionable items. So places where we felt like account access could be a really big, important driving point. So one of the things that we focused on in our discussion was the success of partnering, taking Bank On accounts and having them available and being promoted for when people during the pandemic were receiving stimulus payments and the child tax credit payments that went out. We partnered with the FDIC, with the IRS, and with the CDC to promote Bank On certified accounts that many of them could be opened online, but even for those that couldn't, they were still promoted. And the goal there was to have people have the ability to open an account and seed that account and get a direct deposit from the federal government. Connecting the plumbing, I'm making it sound probably simpler than it was, but it really showed how different partners could play a role and really accomplish the goal of safe payments and connecting to account access. We know it was very successful. The IRS reported in testimony that roughly 10 million accounts were updated or entered into the portal that they created to receive that first stimulus payment, saving people obviously hundreds of dollars in check cashing fees, and then having to buy money orders or whatever they would do with when that money came in. We also know, and I'm also apparently assigning reading, but the FDIC's biannual report on how America banks had a really interesting section showing that roughly 44% of people reported that went from being unbanked to being banked. 44% mentioned that one of the reasons that they did that was receiving a federal payment. So that was the emphasis of our letter on, for lack of better words, plumbing, was to show that the infrastructure can be connected, that while a national strategy has to have innovation and has to have new ideas, some of the things that are already existing simply need to be connected. And there's a lot of groups that have had positive experiences with this, and even if it hasn't gone completely well the first time, the lessons learned are out there, and we can make those connections and do it better.
Thank you so much, David. So I wanted to provide that background for the audience, just to show what a tremendous undertaking this was and how many players and stakeholders it took to get to the point that we are today. So let's get to the national strategy. So it's not published yet, but I was hoping for like a quick sneak peek from our friend here, Natalia. And so the framework lays out some primary objectives. Natalia, can you share a little bit about this framework and some of those objectives within the strategy?
Yes, always up for a little exclusive at the Climate Fed here. I would say first on the framework itself, given sort of the extensive outreach and engagement we've done with stakeholders, one of the things we've heard loud and clear is that the U.S. National Financial Inclusion Strategy should move beyond access. And so that was sort of a very consistent, very strong trend throughout the feedback that we got. So the starting point about the way we think about financial inclusion is really from the access standpoint, but we envision the whole concept as more of a continuum. So it's not a stage you reach as a consumer, it's a continuum. So the first starting point, as I said, starts with access, and that's access to safe and affordable financial services and products, as well as information, right? Consumer financial products are complicated, and disclosures and information is important as well. So the next stage in the continuum, the way we see it, is really financial resilience. And what that means to us is the ability sort of to manage your day-to-day finances, absorb financial shocks and emergencies without sort of significant disruptions to your finances. And then the third step along the continuum is improving financial well-being more broadly. And that includes, very importantly, an opportunity to build wealth, which is important for a lot of the underserved communities in the country. So I think an individual reaches a level of financial well-being when they sort of feel as if they can, fully meet their current and ongoing obligations and have a sense of financial security. I think the ability for the individuals to move to this continuum is influenced by a variety of factors. And we kind of go in detail in the strategy about what these factors are, but I think maybe to bring back a point that President Bostic mentioned is you need a job, right? Like fundamentally, there are labor market policies, there are community development policies that all necessarily tie into financial well-being, but are sort of not the focus of our financial inclusion strategy. Yet they are complementary, and we do voice them and we mention them. So in terms of actors and tactics, we try to, again, reflect the diversity and the robustness of the US financial ecosystem by voicing out that every actor in this system has responsibilities for financial inclusion. And that includes your nonprofits, the private firms, the private market participants, as well as us as fellow policymakers. In terms of the objectives, I think a couple objectives I would mention that we view as really critical to enable individuals to move through this financial inclusion continuum. None of them would come as a surprise to you, but I think the first and foremost, access to transaction accounts we view as one of the key objectives in the strategy. The second objective that I would highlight is access to safe and affordable credit. And that is a place where in the strategy we have a robust discussion about the use of alternative data, some of the cash flow underwriting that was mentioned in the previous panel. And then the third objective is, again, trying to move folks along the continuum is access to safe and affordable, again, emergency savings and opportunities to build retirement assets. These are all sort of like access to products and services objectives. One sort of holistic objective that we have in the strategy has to do with consumer protection. So we know that there is sort of a legacy of predatory inclusion, especially preying on the underserved communities, and we thought it was important to link fair lending, to link some of the risks and opportunities in AI with consumer protection. Again, that's an objective that is overarching across sort of the whole continuum. And then for this particular audience, maybe the objective that I would mention is around government as a leader in inclusion. So from the Treasury perspective, we're the largest user of the payment system. Just I think last year alone, we dispersed over $7 trillion as federal government. Treasury processes the major, the lion's share of those payments. And what that really means is that we have, an enormous opportunity and an impact on financial inclusion in the way we deliver and design products. So that goes back to some of the work that David was talking about during the pandemic with disbursements of the economic impact payments, child tax credits, and historically low levels of the unbanked households that we've seen coming out of the pandemic. I would also say, we enable consumer choice at Treasury. So we have a Direct Express program, which is the largest prepaid debit card program. And it serves about 3.8 million of unbanked or underbanked consumers at the moment. So it's actually currently going through a rebid process, and we're emphasizing the importance of innovation in there. We're emphasizing the importance of customer experience with this prepaid debit card. Again, emphasizing inclusion points there. And then I would be remiss if I didn't talk about direct file. That's yet another sort of example of how we as federal government can promote and expand financial inclusion, really by providing a free filing option for taxpayers, first and foremost, but really, throughout the life cycle of this particular pilot, we've received an overwhelmingly positive taxpayer feedback on it. So yeah, that's again, caring about consumer experience, customer experience, and then making sure that we're, promoting inclusion through all of these tools that we have.
Excellent. Thank you, Natalia. So clearly the Treasury is one of the biggest players in the payment space, is in a good spot to help direct us here for this strategy. David, as you heard of those objectives that Natalia just spoke about, can you point to a couple of those that might tie to your work?
Absolutely. Well, so first and foremost, I think we support all of them. Let me start there. But one piece, hearing you say, and I don't think this can be emphasized enough, that, the government and specifically Treasury as the driver of the payment systems is really key and really important. So we, in our comments, we emphasize not just the economic impact payment and child tax credit payments, but we looked at other agencies and where payments are coming from, whether it's Social Security. Believe it or not, there's I think just under 1 million Social Security recipients who are still receiving paper checks in some form, who aren't on Direct Express or with a particular financial institution receiving direct deposit. We've met with FEMA to talk about, an average payment is about $3,000 for relief from a federal disaster. So there's another government place. And obviously paper checks during a time like that where you're probably not even able to receive mail, let alone take a check and take it, receive a check and take it to the bank or credit union is important. And there are other places too, obviously, the HUD Housing Voucher Choice Program, though it's changed over the years, there are still some cash payments that go out locally for like utility assistance and other pieces that are out there. So there are just so many touch points where the government at the federal level, obviously, can be important. And then we also emphasized that at the local level, we've seen a lot of innovations too. So, in terms of account access, that was a big one as well. So we really focused on two of them being, government being the driver of payments, and then account access being just, really critical. So at the local level, one of the things that we emphasize is the success, particularly of two states during the pandemic, in Maryland and Illinois, who worked with us and other partners to really promote bank-on certified accounts for people that were receiving unemployment compensation or unemployment payments. Obviously, it was a very different time at 10% unemployment. And then obviously there was a lot more money coming through unemployment with the up to $300 in federal backed additional pandemic relief. And there were a lot of people who were receiving paper checks or using a bank account that maybe wasn't serving them the right way. And so these states particularly promoted and drove people to those accounts and said, look, we don't really want to do paper checks. We don't have to. There's a lot of fraud with paper checks. You're asking for 3 to 7 extra days to receive your payment. And then of course, depositing and waiting to get cleared, like direct deposit is a better way. So watching those states be innovative during a really big rush to get payments out also showed us locally that connection between both access and government payments. And so those are the two that we most closely identified with.
Thank you, David. You're preaching to the choir on the death to the checks, but
I know this.
So, Erin, regarding the Aspen Institute, do any of the objectives jump out regarding your work?
Yeah, so before I jump into objectives, I just want to applaud Treasury's work for focusing and framing the national strategy on outcomes for households. And just really want to highlight and applaud their leadership on really directing everyone who works on financial inclusion toward a set of outcomes for households, particularly around financial well-being. The work that those of us in this room really care about is, yes, about increasing access, but increasing access to what end? Brian talked about this on a previous panel, that use of alternative financial services is not changing because people have access to a bank account. It's really about what does that transaction account allow you to do, and how does it integrate with your own financial goals and your journey toward financial well-being. And so a framework that we at the Financial Security Program developed and in consultation with our partners, and we were so excited to see echoed in the RFI language, is really moving from access as the end goal to access as the floor, recognizing that there is so much real work that still needs to happen on access, but really focusing on bankable moments as an example, and really thinking about that work will not end. But the framework that we put together at FSP was really starting with access and then moving into use. Is this account, is this product, financial service, whether it's a retirement account, whether it's life insurance, or access to a checking account or other payment rail, is it something you can use easily? Is it something that fits in with your life and is accessible to you beyond the checkbox of, yes, I have an account, but it's dormant because it actually doesn't meet my needs? And then the flip side of use is benefit. What benefits is this product or service offering you? Does it have reasonable fees? Is it helping you grow your wealth, invest in entrepreneurship, work toward home ownership or other growth in capital markets? And so we were really thrilled to see Treasury's language, at least in the RFI, really reflect that access, use, and benefit, which I think is really a big step forward for the financial inclusion field. So we're so excited to see that and see what it looks like in the final publication of the strategy. And then in terms of objectives, all of those issues are part of our bread and butter at the Financial Security Program. So I'll just end by saying that we're really excited to see Treasury's work on measurement and both reflecting measures that already exist, whether it's making use of federal data like the SHED, consumer, other consumer health data, nonprofit partners like FHN's Pulse Survey, and integrating with the OCC's emerging work on financial health vital signs, to really center all of us and give us all jobs to do that are related on delivering better outcomes for households. So all of, I could wax on and on about these objectives, but I think that's what's new and that's what's exciting for us, is really centering this on what does it mean for real people and how does it help real people improve their financial well-being.
Excellent. Thank you so much for that. I can hear the passion that Erin has for this. I want to take this back to the stakeholders. There are certain categories for who can take action. Everyone in this room can take action, right? Natalia, do you have any general direction for stakeholders interested in advancing financial inclusion efforts that you can share with us at this point?
Yeah, absolutely. I would say if you think about sort of broad general concept of financial inclusion, this has been already mentioned many times during this, during previous panels. But I think building inclusion at the outset is something that really resonates with us in the strategy. I can't share specific recommendations for stakeholders yet, stay tuned for that. But I would say, think about the continuum that we've outlined that starts with access, then moves on to resiliency, and then ends with well-being and the opportunity to build wealth. And then within that continuum, every stakeholder, has a role to play. And I think this particular panel likes to take on assignments and, give themselves jobs. But I would say, for us in the public sector, the way we think about program changes, product delivery, that's something that we'll be focusing on in the strategy. For the folks in the private sector, it's all about sort of inclusive design from beginning to an end. And then for community and nonprofit sectors, it's about, the way they, really track to their area of expertise and deliver financial coaching, advice, et cetera. And then for researchers and academics, where we see a lot of action that could be taken, is really around measurement of what are the outcomes and what are the tangible benefits for households and consumers. So I would say, like, within your own area of expertise, think about the things and the activities that you already partake in and how that could be sort of baked in more with financial inclusion.
Excellent. I think Jessica's cue means it's question time. So let's go ahead and get into that.
Very good. First, we'll go ahead and take questions from the room. Is there one here? Great.
Thank you. I'm with a state nonprofit here, consumer advocacy organization, and I wanted to ask you a follow-up question to a question asked of the earlier panel related, and let me be also thank you so much for the important work you're doing. So grateful. They were asked a question about the synapse collapse, and I don't think the answer was really full. And I think
you hold the mic up a little bit more?
I'm sorry, and I think it's so because we know that a lot of the consumers we interact with, particularly younger people, think that these apps, whether it's Cash App or not on, whether it's Cash App or Venmo, they think that that's an actual bank account. And the customers who were Chime with the collapse and all those people suddenly didn't have access to their money and didn't realize that those funds weren't even FDIC insured. So as you're trying to get more inclusion with safe CFE, national standard bank accounts, how do you counter the misinformation about some of these fintechs that have nothing to do with a real bank or with the real kinds of protections that come with being with a bank?
Who wants to take that?
Oh, man.
That feels like a you question, David.
And I set myself up for that because I was the one who asked the synapse in the previous panel. So this is what I get. So I think that I have a lot to say on this, and I'd love to chat after the panel. But to be brief, I think that one of the reasons that Bank On doesn't certify fintechs is exactly what you've asked about, is that we work directly with banks and credit unions who are federally insured on their deposits, and they're regulated and supervised in a way that's very transparent. And so I think those are the pieces that we've consistently looked at. I also, I've been watching this, and when bad things happen, and they can happen business-wise to banks and credit unions as well, having that faith and in the federal regulators and institutions to sort of, for lack of better terms, keep the lights on, has not failed, right? So there was actually, I just read an article a couple of weeks ago about a local credit union here in Atlanta that failed. And what the article, it was buried in there, but it was so important because what it said is that credit union members on Monday, that it closed on Friday, reopened with new leadership on Monday, and no money, ATM cards worked, debit cards worked, bank accounts worked. And I thought, this should be the, not that I was like in the newsroom, but this should be the lead. Like, this is the most important part, especially for underbanked and LMI consumers. This is the really important part here, is that the continuity exists there.
Thank you. Now, yes, we have another question.
Do we have time?
Yes.
I am Jorge Jimenez with Juniper Payments. A comment and a question. So let's see how it goes, and then I know in between the break. The question is, as we're having all this work in financial inclusion, and you all talk about it takes a village, and it does take a village, is how do we make sure that we coordinate within the different entities, but also within the same institution? Give you an example. In the case of the Federal Reserve, you are doing financial inclusion work, but you're also doing examination. So the question is, how do we make sure that the examiners that are examining financial institutions are aware of the work that is trying to be done? And they're not always aligned. So that's a consideration there. And on the other side of that, I heard something about death to checks, but I'll I'll show you something later about how checks can be interesting in doing instantaneous payments, but that's a different thing. But about the two sides of the medal, on the examination and the financial inclusion, it's kind of like the prairie dogs. You finance prairie dogs on one side and you kill them on the other side. So you want to make sure how we.
So actually, I'm going to jump in and answer that question. In the back of the room is Evan LaFleur from the board, and he's been doing a lot of work on educating our examiners, and they've come up with a framework introducing financial inclusion principles. So that would be a great connection to make and discuss. But then I'll let you guys take the floor.
Yeah, I think your question applies not just to regulators, but also financial institutions, nonprofit partners. I think something that came up really loud and clear in our working group on inclusive finance is where financial inclusion lives within an institution really impacts how you see their work out in the world. If you take, most financial institutions are set up and segregated along product lines, right? There's a credit card team, there's a transaction team, there's a mortgage team. And so where financial inclusion lives really makes a difference on the kind of initiatives that corporate leaders or financial institutions are able to put forward, but also how their employees are measured, right? If you sit on a credit card team and financial inclusion is not a part of your performance evaluation as a member of that credit card team, it's not likely going to rise to the priority within your team. So part of it is thinking about how institutions are structured and where inclusion sits within the business model. And I have said this before, but to any academics in the room, I think there's a great paper that's begging to be written about a typology of financial inclusion or whatever you call it within institutions, whether it lives as a part of your foundation, corporate social responsibility, integrated within a team or its own department. So open call to any researchers who are interested in writing that paper, please let me know. But I think it really has impacts outside of regulated bodies and regulators as well.
That's an excellent point. And one thing that I would add to it too, and I promised Lally that I would give the disclaimer that I'm speaking not on behalf of any of the federal regulators or anyone on the stage, but our organization, which is, I wouldn't, definitely don't discount the CRA modernization reform that spelled out for the first time residential retail products and not just lending and other pieces in a specific section for large financial institutions. I recognize there are legal and current things happening, but that expression is sort of a little bit of, I think, what you're talking about, which is giving CRA examiners at least and evaluators something in front of them that says, hey, if you're, you need to be offering, we're going to reward you for offering retail products in the community that fit something like this financial inclusion strategy.
And maybe I'll just close and say, collaboration is hard. My office runs the Financial Literacy and Education Commission, which is 23 federal agencies, chaired by the Treasury Secretary. So I think it goes to the point of where financial inclusion and financial literacy and education lives in the organization is important. For us, it's chaired by the Treasury Secretary. But also I think it's necessary, right? Getting these folks into the room 3 times a year, coordinating the agendas, facilitating these conversations is extremely difficult. But I think at the end, as you'll see with the strategy and the efforts that we as, USG federal government take on financial inclusion, at the end, absolutely worth it, right? Because they're informed by a huge number of stakeholders and really incorporate diverse perspectives to move the field forward.
We have 1 or 2 minutes, and I have 2 questions. One is, can you address skepticism and mistrust of financial institutions? And another one is, we are experiencing the era of financial influencers in social media. You talk about wanting to be the leader in inclusion. Do you plan to work with these type of entities? And so you can take either question to end.
I'll say if anybody knows an influencer, let us know. We'd be glad to use them for marketing.
Likewise, let us know. I think for Financial Literacy and Education Commission specifically, right, that's a body that really is dedicated to raise awareness on literacy and education. I would say it is important in the way that we approach our audiences, and we try to be as proactive as we can be. I would say partnering with institutions and stakeholders like FDIC, for example, we found to be very beneficial, especially during the economic impact payment that we distributed. We partnered with both CFI and FDIC to make sure that we're promoting and providing information about insured depository accounts, right? So we try to be that one-stop source of information that is trustworthy, that is providing it in an accessible manner. And so to an extent the influencers can be helpful in that endeavor, I think we would welcome that.
I sincerely hope that my 3 teenage daughters are watching me get a question on social media influencing. But I will take the trust question and try to answer that. So that I think what we've really tried to do with sort of promoting and creating a bank on brand is to say that this account doesn't change per month based on how much you use it or how much you don't use it. Or, if you're at $5 in your balance or $500. And so I think you build, what we've seen at least, is that you build trust by, having an account that does what you say it's going to do. And by, getting people into the account and not denying them access to the account. And that builds trust individually and then also reflects then cascading into the community, because the best marketing strategy is always family and friends. I remember in my early days of working in the VITA program and free tax preparation, no matter how much money we spent on marketing, it didn't seem to necessarily increase the amount of VITA clients that we got, but word of mouth was always the best way to do it. And I think that is what we look for in these accounts, is that, we're the financial institution partners are honoring what these accounts are intended to do. And that I think fosters and creates trust. And then of course, as I was answering before, I think that, the fact that when they go to pay a bill or make a deposit, their money is there and it's still there. And I think that is our best way of building trust.
Thank you. And I was just speaking to my colleague, Claire Green over here. We saw a presentation last week talking about if you look at the unbanked, a survey of FDIC unbanked households, those that choose not to have a bank account because they distrust often have never just been exposed to them. So just saying the familiarity starting young, these kiddie account ideas, maybe a way in. So I just have to say, I'm kind of fangirl over here. I've read all of your work and I follow everything you guys have been doing over the past few years. So I very much appreciate your time and thank you. And we're going to go for a 10-minute break right now. And we'll be back at 4:10 for our final panel from our cash in, cash out networks.
Every other Friday session.
Welcome back to the Payments Inclusion Forum for our final session, our fourth session of the day. The role of cash in, cash out networks in payments inclusion. And I will be your moderator today with my four guests here. Crystal Bryant-Minter, Senior Vice President of Money Movement from Green Dot. Greg Donahue, Vice President of Network Solutions, NCR at Leos. Elizabeth Mansfield, Vice President in Account Management for Banking and Fintech Solutions at Paymentus, and Maria Smith, Vice President, Payments and Financial Services from Walgreens. It's great to have a merchant in the house, so, it's a very diverse crowd, so thanks to everyone for being here. But we are going to be talking about cash in, cash out networks. A colleague of mine, economist Oz Shai, has written a lot about cash in, cash out networks being the last mile. And a lot of the research that we were doing over the past several years really tried to focus on not necessarily the unbanked, but cash reliant populations, as some choose to be cash reliant, cash based, or some are kind of forced into that hand. But there's still a need to participate in the economy, and we're here to hear about how you guys make that happen. Many of you have probably heard of M-Pesa in Kenya and other jurisdictions in Africa that has had great success in providing cash in and cash out networks. And you can't often go to a financial inclusion conference without hearing about that example. So I'm not going to talk too much. I'm going to lead the conversation a bit, but let's give everyone a chance to open and tell us about what you're up to in your shops.
So good afternoon, everyone. I'm Crystal Bryant-Minter. Like you mentioned, I'm with Green Dot Corporation. We are a fully regulated digital bank and fintech that offers a full stack BaaS platform and embedded finance financial solution to consumers and businesses. In addition to access to a vast retail network, cash in and cash out network, that serves over 6,000 different businesses and consumers, that provides access to different cash solutions and embedded finance solutions. We are extremely excited to see that this work and research has been done, especially on this topic, just particularly because, especially in the underserved market, underbanked market, cash preferred customer market, there still needs to be access to this different financial inclusion retail network that allows customers to have access to make payments or accept payments, to load deposits to their accounts, for example, in places that are convenient and accessible to them. And so many of the panelists here are partners of Green Dot as well, where we collaborate to provide this vast network, which is of over 95,000 retail locations in the US. In fact, over 96% of the US is within 3 miles of one of our locations. And we're really excited to be able to speak about this topic to make sure that we continue to provide access, which is critical to the mission of Green Dot, which is to enable banking solutions to all customers and businesses and give them the power to bank affordably, seamlessly, and with confidence. And so thank you for having me here today. Really excited to talk about this.
Thank you, Greg.
Yep, thanks so much. Afternoon, everyone. Greg Donahue, worked for NCR Atleos, which is about a block and a half that way, just up the street. You probably drove by it on your way in. One of my responsibilities is operating the Allpoint network, which is the world's largest surcharge-free network. Here in the US, we've got about 40,000 ATMs. Some are cash dispense only, but about 15% of that network actually accepts cash deposits. And we partner with phenomenal merchant partners like Maria at Walgreens to bring that to bear in supporting about 1,100 issuers, banks, credit unions, a lot of fintechs as well through their sponsor bank relationships, and really supporting financial inclusion. About 30% of our ATMs across the network are in LMI designated zip codes, right? So we're very, very focused on delivering against that product promise to deliver not only access to financial institutions, everyone from Capital One down to fintech partners like Commune, who cater to a very, very different audience, but being able to meet everyone where they are in terms of convenience and being able to combine trips with everyday banking transactions.
Elizabeth?
Hi, I'm Elizabeth Mansfield. I'm the Vice President of Account Management at Paymentus. So what Paymentus does, kind of twofold and twofold into what my world does, we support banks and credit unions with payment services. And then additionally, we support billers. So think of the billers like the merchants. When I'm saying billers, you're paying your utilities, you're paying your healthcare bills, you're paying your rent. Those are our clients. So we processed, I think in 2023, 450 million transactions for 35,000 consumers and billers as well. So when we're talking about financial inclusion, this is something that's really near and dear to my heart. I came from a credit union previously, and credit unions are very pro financial inclusion and making sure that everybody's paying their bills their way, their financial health. And so when I came to Paymentus, I was really excited to see that they already had a large push to develop these cash in, cash out networks. And we have our partnership with Green Dot, which has been fantastic because what it's been able to do is digitalize these cash payments for the merchant side so they don't become scary anymore, right? So the merchant's getting the payment, they're getting, you know, the envelope of cash, they're having to staff their locations, they're having to have security because they're taking cash. And most often they're required by the regulators to do it. If they're a large, you know, government regulated utility, they're required to take it. And so what Green Dot provides us is a network of locations like Walgreens where our clients clients can go in and pay their bills in cash and still have the benefit of the digitalization of instant payment processing, reconciliation, and reporting.
Thank you. And then finally, Maria.
That leaves just me. So I'm Maria Smith, and I head up payments and financial services at Walgreens. Just so you know what that really means, because it's quite a bit. Payments is acceptance, right? Everything that we take in terms of form of payment, and we do accept a large portion of cash still. Financial services includes products that are focused on low to middle income, but it's also our ATM services, our money remittance. We also have products on a shelf that consumers need to get digitized. We also do what we call in-lane payments, which is really kind of this cash-in network. We do high volumes of that, more recently, higher than most, I think. And with more than 8,000 locations, we're probably one of the largest networks. It's important for us to provide those services to our customers because a lot of our locations we feel are in financial deserts. And you guys have heard that before. We use it all the time because we find that in the communities we serve, there are many times financial institutions, traditional financial institutions that are not present. And we are the location where LMI communities come to serve their financial needs. Not all demographics, but a large portion of it. We also have our own proprietary financial products, hoping to serve an additional need that we haven't had met before. I'm really passionate about financial inclusion because I know that certain clienteles trust us. Imagine that, a retail pharmacy for financial services. And I was surprised when I joined Walgreens about 3 years ago. I've been in financial services for over 30 years, worked for name brands like Disney, Starbucks, and Expedia. So to find that a retail pharmacy was a trusted financial services partner was really shocking to me. But it made sense when we partner with the networks and the folks that are on this panel, as well as in the room, that we are a trusted partner because of the services we provide, because of those who we choose to partner with, and make sure that there are options for this LMI community. So I'm passionate about this discussion specifically, but I'm also passionate to ensure that you understand the merchant perspective on this, which is not common in the payment space. And so I'm happy to be invited and included in this panel.
Well, we're very fortunate to have this panel. This is a supply chain. This is working together for a financial inclusion strategy. And so let's go ahead and dig into how this all works. But first, the last panel mentioned outcomes and really understanding like what's the purpose? What are we looking to achieve? So I'll start with Greg and kind of pose that question. What does successful financial inclusion look like?
Yeah, I think it's a great question. I think we'll probably go around and share perspectives on this, and everybody's will be a little bit different. But for us, we operate an ATM network. So when I think of inclusion, I think it's scaled capabilities. Right. And when I mean capabilities, I think it has to get beyond just delivering cash withdrawals in a fee-free capacity. You now have to do that in a way where you're accepting cash as well, to be able to allow people a little bit more upward mobility in the financial ecosystem. Right. You mentioned that, that there's a lot of folks who are sort of forced into a cash-centric ecosystem and lifestyle. And one way to help bring them out of that, or if they so choose, is to allow them to digitize their cash, right? And creating more endpoints to be able to do that. So I think scale capability is important. Obviously, convenience and confidence and knowing that they're going to be able to find a place or an endpoint to be able to complete that transaction is critical. And then for me, I think maybe the biggest element is trust, right? We have to build trust in this ecosystem, because the reality is a lot of the people in these vulnerable communities have had bad experiences, right? And maybe that's a new experience that occurred, or maybe it's something that goes back generations, right? But I think it's incumbent upon all of us to sort of bridge that trust gap, right? And deliver things that are easy and barrier-free, but ultimately they can trust. And I think one example is of that is across our ATM fleet, right? Our 40,000, we support multiple different language types. So if you are a Fintech that is catering to first-generation immigrants or something like that, that can be really challenging and confusing for people to interact, right? So removing some of those barriers is, I think, how we do that, and doing it at scale in a way that builds trust and confidence.
Yeah.
I mean, I think that's really important. For me, I think about it in three ways. I think about it in terms of access, convenience, and consumer choice. Access being the similar things that Maria and Greg mentioned, just being able to find a location, especially in financial deserts and banking deserts, but also timing of that location. Most banks close, at 5 or 6 p.m., sometimes even earlier now. And if I'm the working mom that's getting off from my waitress job and I have a handful of cash tips that I really need to get into my bank account tonight because I have a bill that's coming out tomorrow, I need to be able to go to a location where I can do that when I get off. And so the Green Dot Network being able to provide, pretty much 24/7 access, because we have locations like 7-Elevens that are open 24/7 to be able to make that type of cash payment when it's accessible to me is very important. Secondly, the convenience option, right? Being able to do that in one trip, right? So while I'm picking up my groceries or while I'm picking up my pharmacy prescription, I can make that payment in one trip. It saves me, a secondary trip tomorrow where I have to go to the bank. And then just choice, if I want to make my bill payment in cash, I want to be able to do that, right? Maybe my bank account's overdrawn, but I still want to pay my light bill, right? And so giving those customers those three facets allows them to participate in this digital economy when they don't necessarily always have the options to do so.
Yeah, I think just to piggyback off of what Crystal's saying, it's interesting on the digital piece, and actually the bank piece really resonated with me. I know obviously during the pandemic, we saw a lot of bank branches closing down. We saw a lot of push to digitalization where, the FIs kind of looked at it like, oh, this is finally our chance to digitalize. We can shut down some of our branches. There were lots of mergers during that time. But really what they did is further alienate the cash preferred population. And I think now we're seeing, okay, we're out of the pandemic, but some of these trends have still stayed. You get, the ATM tellerless branches. Those don't work for the cash preferred population necessarily. And I think when we're doing this, it's just so important. It's so important that we're meeting those customers where they are. And I know that sounds a bit simplistic, but truly you have to meet those customers where they are and you have to make it simple for them. And when I'm talking about meeting them where they are, that's locations that are close to their house. If you look at the maps of all of the locations that we get through Green Dot, there's typically something, I think the percentage is everyone has within 10 miles from their house, some location that they can pay in cash. So if you're out in the rural country, you only come into town once a week, you have to pay your bills, you're able to do that while you're doing other errands as well. And it's convenient. And also the customer feels like you understand them. You understand their needs. You're not just looking at some of these other, historically digitalized channels. And then also in addition, having the simplicity. So on our payments page, when you're checking out for your bill, you've got all of your kind of standard options. There's an option that literally says cash. So that's simple. No, scan to pay, nothing proprietary that we named it, just cash. That way people know that they can go pay with cash, get the barcode on their phone, and go into, I think it's 45,000 retail locations right now that we have up with Green Dot.
So I think you guys have mentioned everything that is valuable for Walgreens, and our stat is 85% of the U.S. Consumer lives within 5 miles of a Walgreens store. So convenience is very important, but accessibility of the products and simple is what's important to us as well. So we select who we have in our store in terms of financial services. We select who we accept as cash in, aside from our ATM units. What we do at the point of sale has to be a consumer preferred product. So paying a bill, for example, we really love that, but it also has to be simplistic because the cashier can't explain what you're doing in that environment. They are really just trained to understand and read and scan and take cash, if you will, and move from there. So the product has to be simple. It has to be high value to the consumer. It cannot be predatory. And then it has to make sense with what we think is valuable to our consumers for their financial health and well-being. Someone mentioned that earlier. I always use that because, health and well-being means more than just your medical well-being, also means your financial well-being.
Thank you. Let's move on to you. I mean, you did a great job kind of describing the overlay of the retail network and kind of addressing this concept of banking deserts and really bundling goods and services. But talk a little bit more about cash and why merchants should continue to take cash, maybe, or why not? And, you know, maybe from the FI standpoint, how underserved are focused on cash.
Yeah, I'll take a lead on that. So at Walgreens, about a third of our payment types are still cash, meaning they're buying goods and services from us, they're paying for prescriptions in cash. That tells us there's still a large demand of cash use. We know that, and we have large debit users as well, less than credit users. And I always thought debit users didn't use cash because debit was equivalent, but that's not true, because what we find is that cash users are partitioning their money. They're budgeting separately. They're making sure they're paying essential bills. And sometimes that doesn't mean depositing it all in their bank account, for example. So for what we represent is they either, you know, choose to put money in a digital wallet. They choose to put it on an electronic card, which is just a traditional GPR. They choose to put it in ATM, or they choose to pay the bill with us. And we're finding that it's not just non-traditionals. I think, Greg, you mentioned that Cap One is one of the largest, you know, new cash in partners I think we have. We've been asked by a number of other financial institutions to be that cash in. So for us, it feels like a very important consumer need that we're meeting, especially in those financial deserts that I mentioned. The opposite of that, though, is it has to be simplistic for us to explain to our customers. It cannot be cumbersome for our cashiers who are, you know, probably, you know, earning minimum wage. And it has to be simplistic for that. It also has a bit of a burden on us. We have the AML responsibilities, and we're going to talk about that a little later. But from a merchant perspective, there's a lot that we have to do when we take these cash products in. So it's not just a simple transaction to us, it's an engaging relationship. And so we want to make sure that all of the providers of the products and the financial institutions on the other end understand that we're a network that they're engaging their customers, our mutual customers, in a way that's positive for them, not just a transaction that is being sort of, you know, includes maybe an additional purchase of something in the store, which is beneficial to us. But we want to make sure that we have that relationship with the customer as you do, you know, on the financial institution, on the product side.
Yeah, that's exactly right. I think from the financial institution side, there's a variety of reasons why there's cash preferred customers, right? It's I cash my paycheck every Friday. I get that. I put my cash into different envelopes so I can do my budget. This is how I've always done it. This is how I'm always going to do it. And I think there's a variety. And there was an interesting question, an interesting point about kind of the utilization of digital wallets with like Zells and Cash Apps and the lack of security. And people aren't educated to understand that there's no security and no FDIC insurance within those. And so I think we're actually seeing now some of the younger generation also reverting back to cash. And we need to make sure that they're able to pay their bills. When I'm talking about utilities, I'm literally talking about somebody being able to keep their heat on in the winter. And during the pandemic, we knew that this cash was such a need. We would have consumers going to the biller's physical locations with an envelope of cash and trying to slip it under the door so they could pay their bills to keep the lights on, because those offices obviously aren't served. And I think as we all sit up here on this panel, everyone has a different kind of piece of this puzzle. And we're all motivated to make sure that cash acceptance is still front and center, even though we have all of these amazing digital channels and digital options. We can't forget about the underserved, underbanked, and cash preferred.
Yeah, and I would say, you know, despite the growth in mobile adoption and digital bank adoption, there was a recent stat that I read that still, you know, of all the cash preferred customers, at least 60-70% of them still want to make their payments in cash, even though they have digital bank solutions, right? It's just easier. It's one less step. Instead of having to go load my cash that I already have on me into my bank account and then going to my bank account to make that payment, which if it's by ACH, for example, could take 2 to 3 days. Instead, I skip that whole step and just make the cash payment and post directly to my biller that same day, right? And then I avoid late fees and things like that. So sometimes when we're not in those particular same situations, we don't realize some of the other consequences that happen in terms of timing, right? Like, I'm not worried in particular about a late fee, but a different cash preferred low to moderate income paycheck to paycheck customer is counting every dollar. And it's important for them to be able to make that payment the same day, right? So that they can avoid that fee instead of putting it into their bank account, for example. And so while we do encourage, one other side of Green Dot is we do, many different digital banking solutions. Like I said, mentioned earlier, we're a banking as a service and embedded finance provider. We encourage even on our own products, like to set up direct deposit and convert cash customers to digital, but there's still always going to be this customer that doesn't want to do that, right? And we need to be able to provide those solutions to them to still give them financial inclusion.
We're going to dive into a technology question in a minute, but before we do, I just want to get this out of the way. Fraud and scams, how does this swing, the pendulum with benefits of cash or opportunities that you see due to those issues? Fraud and security.
I'll start that off with fraud and security. Yeah. So our solutions are designed to be very, very sort of fanatical about compliance, security, and the consumer experience, right? So Allpoint is an EFT network, right? So as an example, when bad things happen, right? So if ATM doesn't dispense cash, or in a case where you put cash into the ATM and it eats it and you don't get credit, or whatever the case might be, we take the obligation, we take the onus as the acquirer, right? And in that case, the onus is on us to resolve it. And if we don't resolve that in a certain period of time, we have to pay the cardholder back, right? So the other, I think, interesting thing is, we'll talk a little bit about AML and KYC. Our solutions are designed to fit into the existing processes that come with either a traditional financial institution who partners with us for access to the Allpoint network, or a fintech who gains access via a sponsor bank like Cross-River, right? So we want solutions that are easy to implement, things that fit into what's already there, into existing processes and things like that. And then from a fraud perspective, we've learned a heck of a lot over the 40 years as sort of NCR and NCR Atleos in managing the world's largest financial institutions ATMs, right? And so we take all those lessons that we've learned over 40 years managing ATMs in sort of that environment, and we port them over to our solutions in the retail environment. So as an example, everything we deploy is what we call bank grade technology. It's the same things that the largest financial institutions purchase today. And an example of that is cash recycling technology. So all of our deposit capable ATMs utilize cash recycling technology that validates each note against a currency template that we get from the Fed, right? That gets updated every single quarter, or if we find a super note or something like that. And so we're catching counterfeit, and we're getting that out of circulation. And we provide a very, very secure solution, again, designed to build trust and confidence for the consumers that we serve.
So I'll add, I think this is where we should talk about AML a little bit. So
Sure.
when it comes to fraud and security, if you can imagine from a merchant perspective, we are the front point to that, right? So there are a lot of activities in the marketplace today that are organized crime. Unfortunately, we have a lot of retail crime happening, as you know, a lot of items being taken off shelves. That's a simple thing to talk about. But when it comes to fraud and security of financial services products, we do rely on the financial product provider, the financial institution, the fintech, whatever it is, to do the KYC for the individuals. That is really sort of the security we feel partnering with the various partners that we have in this area. From a AML perspective, merchants are required to handle suspicious activity or suspicious incident reporting. It is really a high compliance and regulatory cost to us. And I don't think most people can appreciate that. And the reason is obviously for anti-money laundering, but also we want to ensure that we are also the front line for consumer protection. So we are the ones that are seeing, someone that's being asked to come up and fraudulently purchase gift cards to pay for their, grandchild that's been incarcerated somewhere. And so we have to provide that education to our consumer, to our team members. We provide that training to make sure that they could, and the policy that they could stop that transaction from happening, but also the signage for the consumers. So when you think about fraud and security from us, we have consumer protection, we have AML, we have what we trust our partners to do on the KYC side. So we do spend a lot of time ensuring that the folks in the total ecosystem that we partner with are doing all of their parts, because there is sort of reputational risk that we are relying on for those partners, and as well as our own behavior under these protections. So fraud and security is really important to us, of course, in all those facets. But I would say that we rely on our network partners and our product partners to be that front and center when it comes to those products that, that they provide to our mutual customer.
Thank you. And I can attest to that. Actually, by chance, my mom actually works at a Walgreens in her retirement, and a mentally disabled boy came in and was attempting to buy gift cards, and she just talked him out of it. So we have a success story.
Oh, thank you. Thank you very much.
So
training does work.
Yes. So the next question, let's turn to technology. We would like to know a little bit how this works and business continuity issues that maybe come up that's top of mind.
Sure, I'm happy to kick that off. So the way that Green Dot Network integrates with both our partners and our merchant retailers is all API based. And so we do direct integrations, both directly with partners, but also to aggregators and processors directly, where we're connected to effectively like a network of networks. Our retail merchant partners, such as Walgreens, connects to Green Dot via API through a set of different API calls, right? To just let us know, hey, there's a customer here who wants to make a payment or wants to make a deposit. We receive that call from Walgreens, where we then in turn call the issuing bank or biller partner and say, hey, XYZ customer is here. Is this account open and good to be able to receive a payment? That partner would then respond to us and say, yes, it's a good account, or no, this account's closed, right? And in which turn we would respond to the retailer and say if it's good or not to accept. Then the retailer would then respond back to us to let them know the payment has been secured, which we then in turn tell the partner they can credit the payment. And so what we effectively do is then like a next day settlement process, where then we move the money right to the appropriate party. But all of this is in real time. In addition to those fraud controls, we set as a network different limits to help mitigate fraud and protect the consumer. So we're not talking about, tens of thousands of dollars that can be loaded. In fact, most of our retailers have a limit, a minimum of $20 to $500 a payment. There are some exceptions for rental payments, for example, that are specific use cases that are higher dollar amounts. But all of this, once we do that direct integration, is very seamless, right? And it's instantaneous. We rarely have, any outages. Our uptime for the last 12 months has been over 4 nines. In the rare case that we do have an outage, the retailer is notified not to accept the money, right? And so it's pretty seamless in that integration, very simple. Once we actually establish the connection, it just runs, right? And so I hope that wasn't too complicated from a non-technical person explaining how that works. But it's really just a two-way kind of communication to transmit those payments.
Thank you.
Yeah, and from an all-point perspective, I'm assuming most of you have used an ATM before in your life at least once, right? But you do have to ask that question. Allpoint is a standard EFT network like Visa or Cirrus or Star, or any of the networks that might appear on the back of your debit card. And so when we partner with an issuer, again, whether it's an issuer that is partnering with a fintech or a traditional financial institution like Capital One or PNC or USA or any of those, they join and they add that network just like they would add any other EFT network. The process is super simple. Takes about 30 days to do it. It's not a big cost, not a big lift. There's not a big barrier to entry there. in terms of joining the network. And I think it was a great point around the controls from a transaction perspective. That is something I think everybody's sort of starting to figure out what's the right mix. We've implemented controls that are variable by issuer, and all in this effort to find the right mix and providing the right capability for cardholders, but then also providing the right level of security for the issuers and compliance and all those types of things.
Elizabeth?
Elizabeth?
Or Maria?
The only thing I could add here is obviously, we have several network partners at our point of sale. Some of our systems are not integrated, like in the ATM, they're not necessarily integrated. But on the point of sale, obviously any integration we do is timely and has to be justifiable, if you will. So we love having network partners where we can have multiple purposes. So a lot of our network partners, and Green Dot's one, Income is another, we can do cash to load, we can do bill payment, which we love. And the more we can add into those networks from a merchant is simpler. So you talked about technology and how your systems work. We have internal controls, and we also have systemic controls. And now we've added more ID tracking purposes to help give more information to you when we have some bad actors. But we have various types of controls because we cannot create or we cannot control what the consumers do. In your example, sometimes when we have limits that are set by a partner, sometimes our cashiers allow multiple transactions to happen in a limited time. That is basically breaking a control. So we try to have those controls that will prevent the bad behavior from our cashiers, but also that allow for flexibility when a consumer needs to do those types of transactions. So it's a tough balance, but we love working with partners that are flexible and can do multiple purposes. That's all I really have to add.
Yeah, and I think just to piggyback off of that, for us, it's the exact same. And we really needed a partner, which we got in Green Dot, that could implement, that could run it, that could help us. And it's been very, very beneficial and a much easier solution. We know what we're good at and we know what we need to partner for.
Excellent. We actually had a Slido question come in, and I think I have time for one more questions and we'll turn it to everybody. But this Slido question is similar to the one that I wanted to ask. Let's look to the future. Like, what are you thinking about? The question that this woman asked is, one of the points I've heard reiterated is access to money and speed. But what about the proposal for the Fed's proposal for the National Settlement Service hours to expand? That would impact payments happening sooner via ACH. And of course, we have instant payments coming up. And I know when we were talking on the phone, we talked about APIs a bit. So what are you excited about for the future? What are you looking to innovate? Where are you looking in?
I think that's a really interesting question. You're talking again more about kind of digital services. And I think we need to go back to, these are consumers that want to pay in cash. And when I'm looking at everybody in this room, it's probably not you. And you need to understand who these consumers are and why they're wanting to pay them with cash. And I said this at the beginning, meet them where they are and understand their needs. You're not going to force them into a digital channel if they're comfortable paying in cash. But when you can provide these solutions and digitalize it for companies on the back end, it's a win-win for both, right? The consumer feels like, you get me, I'm able to pay cash, I'm comfortable with cash. And then the merchant says, oh, great, I've got everything like I would if I process an ACH card transaction.
I think with some of the innovation that's coming, there would be some cannibalization, just like after the pandemic, right? When there was some shift in more digital payments. However, again, I think earlier we were talking about the death of the check. Like, we've been saying that checks are going to go away for like 20 years and they still haven't gone away. It's the same thing, same way I filled out cash. I mean, in July of this year, I think it was published, there's more cash in the wild than there's ever been in the last 20 years. And it's somewhere, right? Like, whether it's in someone's pocket or under their couch cushion or whatever, it's still out there, right? And I echo some of Elizabeth's sentiments that we still have to provide this solution. I think it's very beneficial, especially to businesses with the faster payment side, right? To be able to get, especially B2B payments, much faster. But when we're talking about consumers, I think there's always still going to be this lingering need, right, to be able to make hand-to-hand payments, right, in person, in cash. And so we can't let or forget about those consumers in our path to innovation for faster payments.
That's exactly right. And actually our connection to when somebody pays in cash at, let's say, a Walgreens, it posts in real time. So it still is a real-time payments, but it's using cash.
Yeah, if I can lead in on this one to talk a little bit about the innovation beyond that. So if we think that cash is still a necessity and we're not going to completely eliminate it, by the way, I still take checks. I know, I wish I didn't. It's reducing, but I still take checks when it comes to, purchase at Walgreens. But what we need to do is innovate the cash system. And I think this is something that we've talked with our partners at NCR before. So we have, we're growing to about 2,200 deposit ATMs now at Walgreens. So talk about meeting with consumers, meet them where they are. They may want to give us cash over the counter, but it also could be cash to an ATM that could be immediate, deposit. But imagine that ATM also recycling it so then it cashes out. So we reduce the number of armored cars. So in a cash environment where I am providing a necessary need as Walgreens, I'm also having to deal with more cash pickups and again, different armored services. So I think that the excitement about a national payment strategy for inclusion to me means that we'll look at every group and what they need from us. So it could mean more inclusion into basic transactional account. I think we talked earlier about that's like the basic necessity, or they may be underbanked. They have other bank accounts, but they're still using cash for whatever reason. We do have to figure out why that is necessary and roll back to the need for that. But we also have to improve and innovate on the entire system. In order for this to continue to work and service those consumers, we have to sort of solve along the entire chain, if you will, and not just assume that digital is the answer to all our problems.
Yeah, I can't disagree with anything that's been said. Sort of as we close things out, looking forward to creating efficiencies in the store with you, Maria, right? And I think that's spot on in terms of innovation. If we look at the Fed's own diary of consumer choice, right, in payments. So quick stats, people that are 18 to 24 years old are actually about 25% more likely to use cash than people that are 25 to 36. And that's a surprising stat, kind of speaks, Elizabeth, to what you're talking about. This isn't just for the normal sets of populations that we've been talking a lot about in vulnerable communities. And then Maria, you brought us some stats around debit users. Debit users, right? People who prefer to use debit cards are actually 30% more likely to incorporate cash as a regular form of payment, right? So this isn't something that's going away. When I think about what's next, I think about established KPIs and established metrics in order to be able to manage to specific benchmarks for financial inclusion. And then I look at what FDIC did around the CRA regulations earlier this year, make it easy for issuing partners, financial institutions, programs, everyone that's out there that supports in the financial ecosystem, make it easier for them to take advantage of surcharge-free networks like Allpoint and networks like Green Dot in order to be able to satisfy those requirements. Look to the utility space to be able to move transactions to a lower cost to serve that ultimately provides convenience and a better quality of life for the cardholders.
Great, thank you. We do have a message on Slido, a question, but we can open the room up for questions in person. Just raise your hand if you have one. I see a couple up here, but in the meantime, how do you handle counterfeiting? Have you seen an increase in attempts if the retail employee is not trained to identify counterfeit bills?
Yeah, that's a good question. I mean, we do have some training, as well as our bank partners tend to tell us about counterfeiting problems. It is a problem. I don't know how else to explain it, but through the training that we do for our own employees and our bank partners, we sort of do our best to mitigate that. We also do have internal controls over maximum deposits, et cetera. So that sort of reduces our risk, as well as the AML and other compliance reporting that we have. Again, internal controls to minimize those risks to us as a merchant.
Only thing I'd add is from a counterfeit perspective, at our solution, if we take it in, it's our problem, right? It's we're the one that has to bear that loss. It's not the consumer's problem, it's not the bank's problem, right? So we don't take a lot of it in, thankfully, but if we do, something slips under the cracks, it's our problem, we take the loss.
And just, we're gonna go to the audience, but real quick, Maria, could you repeat how much cash payments you have?
About a third.
A third.
So that's quite a bit.
Okay, and then audience questions here.
Hi, my name is Charlie Van Dyke with the Atlanta Fed Community Economic Development Department, or program, I should say. I had a question that sort of gets at the piece about meeting people where they are, and this is maybe where I thought you were going to go with the question that Jessica asked about innovation. But you talked about places where your zip code is actually more determinant of your health outcomes than your genetic code. And since you're here from Walgreens, I was wondering if you could maybe talk about the continuum that Natalia was mentioning, that last piece of going from, financial resilience to well-being and health are so tied together in this financial sense. Have you thought about other types of products or services that take advantage of these payment systems to help build wealth, not just transfer payment?
Yeah, we have, but I think we're sort of at the place of just basic transactions, being able to digitize your cash when necessary, pay a bill in cash when necessary, and that could include your healthcare premiums. In fact, we do have a number of healthcare companies that take premiums in cash, Florida and a few other states. So we think of it in terms of what does our population need, and do we have those safe, secure products that they can handle in our store? So we won't do things like, check cashing or certain things. We'd love to be able to partner with the national partner that talks about financial education. I don't like the word financial literacy because that doesn't really tell the story. And when you start talking about financial education, it is really the steps forward to get you into that health and well-being. But I see health and well-being as being able to pay your bill instead of stressing over the utility being shut down. That's health and well-being to me. Being able to give you access, and you may not be able to get to the utility company because bus services don't run that hour, or so there's a lot about that. And so mental health is very important as well. So we look to make sure we are providing services in our stores that have all that. We don't have all the products. There's some products that I like to add to improving your credit, because we have a lot of consumers that really just haven't had the opportunity to use credit or have had problems with credit. And we'd like to be able to provide products that support them in that area. But that's kind of how I look at it.
Would also not to discount the role of small businesses, right? So in a vulnerable community, right, small businesses are sort of the lifeblood, the grassroots of how people are sort of uplifted, right? So when we started taking deposits, I assume you guys probably saw a lot of this similar type of data. There's a very surprisingly large percentage of overall cash deposits that are actually from small businesses that operate primarily in cash. So people like contractors, painters, landscapers, those sorts of things, they get paid in cash, right? And they have to digitize that. And we're allowing them to do that on regular intervals as a part of their daily work-life balance instead of waiting, 2-3 weeks to go to a bank branch or something like that to make a deposit.
I think worked here at the Atlanta Fed and the Payments Forum until I retired last year. They still let me come back in the building. So. Question really directed to Maria, but some of the others may be able to comment with regard to your merchant acceptance points. How big of an issue was it from a risk evaluation standpoint, the fact that you were going to be accepting higher levels of funds in your account from a robbery standpoint or an employee theft standpoint?
Yeah, it's a really good question. We're still dealing with that today. So that is a consideration in some of our locations. In fact, some stores do open 24 hours a day, and we've been asked to limit when we do deposits or take cash in, because they may be only 1 or 2 employees at a certain hour of the day in the store. And so if they take a deposit and it's beyond their cash limit at the register, they have to go put it in the safe or prepare it for deposit. So it is a very important consideration. At Walgreens, we have a lot of regional asset protection partners. And so we are specific to that region, and we're trying to refine our controls down to our area levels to give them more flexibility. We've had to do that as our cash inflow has increased actually. So those are some of the requests. Only allow taking in cash certain times of the day for certain urban markets. And that's usually where a lot of our cash inflow is. Or, make sure that there's multiple employees at that proper location, or asset protection partners have made other recommendations for internal controls. But it is a really important consideration, which is why we don't do it for everyone. Like, we haven't turned on all cash in opportunities. We actually, even with our partners today, we still say, okay, who are we willing to partner with? If it's a bill pay, we're not doing other things like gambling actually. So there's just certain things we're just not willing to do, and that's for the safety of our employees.
It's so interesting because from almost a reverse standpoint with billers, having that cash acceptance go through like a Walgreens takes that risk and that burden off of them, and they're not having to, staff their locations. They're not having to have additional security at the location because they're not handling the cash. And I suspect your team is probably better equipped.
It is, but it speaks to the equitable financial value in the ecosystem, right? I'm not just, looking for footfalls to come in. I now have to handle all the things that you just asked me about, which means there's got to be an equitable share in this. And it is important, but I see that happening more and more as I've, been part of the Walgreens community again for 3 years. So, yeah.
Real quick question, last one. Recently, I've seen pretty significant cash discounts being offered, gasoline, restaurants. Have you observed this, and does it fit into the cash in, cash out network?
Well, typically most merchants are offering cash discounts, so because they're paying interchange on the debit card purchase, right? And so they're able to pass through some discount to the actual MSRP or whatever they're purchasing or buying from a restaurant, because then, especially in small businesses, that interchange rate could be pretty hefty. And so they offer that discount in exchange for cash. And then I would say even for some small businesses, they would prefer to take cash payments for a variety of different reasons. So they incentivize their customers for that. I wouldn't say that I've seen those discounts that are large nationwide retailers, just because usually those retailers negotiate favorable interchange rates for their purchases. We typically will see that in, small bodegas or corner stores or small owned business restaurants where they would offer that discount. But that's the reason why.
Yeah, and from my perspective, we're agnostic to what consumers want to pay us with, right? We welcome all forms of payment. We do have some preferred pay types, obviously my proprietary pay types, which cost me a lot less than my preferred types, but we don't necessarily do discounts for certain pay types, only because we're agnostic. And we do have more favorable rates. They're still higher than I wish to pay, but they're more favorable rates. But that's true. I think that the discounting is much easier at a smaller, even a mid-level merchant than it is at a high-level merchant. That's the other reason that consumers or merchants have never charged also for using credit, which smaller bodegas have done as well. That's just not the preferred customer experience that we want. Right, we want to encourage your visitation and the engagement with our brand, and your health and well-being. So we're going to be agnostic to how do you want to pay us, and we're going to encourage you to pay us with certain things that make sense, or be part of our loyalty program so that we can offer you rewards to come back and do things, again, for your health and well-being.
Well, thank you to this panel for letting us look into your world and explaining how it works and the benefits, and really allowing us to see how innovation and collaboration is really coming together for inclusion. So today, this is the conclusion of the Payments Forum 2024. First, I'd like to adjourn our virtual audience and say we've heard today from Raphael and Sunayna about the importance of innovating and doing inclusion design in the beginning of innovation. Raphael challenged us to pick up the phone and get involved, or the other way around, but here you are, so thank you for being here today. We also heard about innovating in emerging products and why optionality in payments is very important. There's not a right way to pay. It's important that everyone have the opportunity to pay in a way that is not punitive and provides convenience for them. So optionality is something that I think we've heard a lot of today. And outcomes, making sure that we are designing these payment technologies and innovations in such a way that reaches those well-being outcomes that we've discussed, and Natalia will have a forthcoming national strategy that we'll all be able to talk about very soon. So we will adjourn for today. For those in the room, we will have a reception just down the hall, and there will be escorts. If I first want to thank all of the staff here. If you could raise your hand, AV, Lolly Schaefer, and Brenda, and Katie Kai and Carolyn back there. They've done an amazing job, and our mic runners, Nancy and Chris. If you work for the Federal Reserve Board, could you please stand up for me? Or for the Federal Reserve, I'm sorry, anywhere in the Fed. Well, I'm mainly pointing this out because I thank you for being here, but also I can't go to the reception, which is my favorite part. I have to go to the airport with Kathy Tomaszewski, but please find a Fed person and introduce yourself, and they are going to take great care of you and have some fun down the hall, and you'll have escorts just out here. Oh, one more thing. For leaving the building, you will need an escort. The lobby downstairs open to the public. You can go out till 5:30, but that will close temporarily till 6:30 when the reception ends. You can still leave, you'll just leave through the back door. And at 6:30, the downstairs lobby will open again. Thank you again for your time, your questions, your participation. Thank you all panelists, and have a great rest of your evening.